Good morning, good afternoon, and good evening, everyone, and welcome to our Fall 2025 IPO Bootcamp. My name is Colin Mahan, and I'm a Director of Programs at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit improving access and knowledge in entrepreneurship to advance economic progress for all. As you're going to see in the chat in just a moment, the NASDAQ Center provides programs, resources, and exceptional mentorship to help entrepreneurs fuel prosperity no matter where their journey begins. Be sure to check out those links and resources shared in the chat. Now we're going to launch a few polls to take a step back and take a temperature gauge on how all of you are doing today. The first poll, how are you feeling about your business? We use this information to guide the programs we provide for this global community of entrepreneurs. So thank you in advance for voting. All right, looks like optimism is in the lead. Great, thank you for voting. If there's specific topics or challenges you'd like us to create resources for, please also share those in the chat. All right, we got some more housekeeping items as these polls keep rolling. Let us know where you're dialing in from by dropping it into the chat. We'd love to see where everyone's joining us for our time together today. Secondly, we're going to have live Q&A at the end of each panel, so please feel free to submit those questions to us at any time using the Q&A function at the bottom of your screen. We'll do our best to get to as many as we can. While you're answering these last polls, we'd like to take a moment to recognize the incredible support of our corporate partners. The work we do at the center wouldn't be possible without all the generosity and belief of our partners and funders, including Nasdaq, Wells Fargo, JP Morgan Chase, KPMG, Walmart, the Asia Innovation Hub, Wilson Sonsini, the Nareet Foundation, and BPM. We're deeply grateful for their partnership and hope you'll join us in sharing that appreciation. Alrighty, let's look at this last poll. Looks like it is a pretty good mix. Thanks for voting, everyone. But finance and sales and scale look like they are in the lead here. The good thing is we are going to cover a ton of things on those topics. And let's see where everyone's coming from. Wichita, Kansas. Love that. Dallas, Chandler, Arizona, New Orleans, San Francisco, Miami. All right, well, welcome everyone. And without any further delay, please join me in giving a warm welcome to our first special guest presenter for the market update. Bruce McDonald is a managing director at Wells Fargo. Bruce, great to see you.
Thanks very much, Colin. It's great to be here.
Well, looking forward to this, and over to you.
Great. Thank you very much. I am going to now share my screen. And folks, just by way of introduction, again, my name is Bruce McDonald. I'm a managing director at Wells Fargo within the corporate and investment bank. And I help companies raise capital and complete mergers and acquisitions. So it's a real pleasure to be on the call here with everyone today. I'm going to run through this presentation. I hope to keep it as lively as I possibly can. If there are questions, I think towards the end of the next panel discussion, we may be able to get back to those, but looking forward to the discussion today. And the subject matter here is the current state of the IPO market. So with that, I will get right into it. I certainly don't intend for this to be an economics discussion here, but at least one page on the current state of the economy, because it certainly has implications for the overall health of the IPO market. And what I would start with is, number one, we're in a period where we haven't had a whole lot of economic data due to the government shutdown. The last data point that we had on GDP growth, again, to keep things at a very high level, was a 3.8% reading here. And the only mention that I'll make is that, we continue to see forecasts. All of these red bars are forecasts for continued growth within the overall economy. Nothing too hot, nothing too cold, generally speaking, going forward. And so that speaks to stability. The other major indicator that I would point to, everyone pays attention to what the Fed is doing or what we expect the Fed to do. There was a 25 basis point decrease at the October 29th meeting, which is this part right in here. The speculation is that there may or may not be another rate reduction in December of this year. But then you can see the expectation is that by virtue of the overall economic stability, there's not a huge need for the Fed to be incredibly active, which at the end of the day is actually good for the IPO market. And so this notion of being relatively stable and not expecting the Fed to make a whole lot of moves is a positive dynamic. The only other thing I would make before leaving, or only other point I would make before leaving this page, is relative to, we did get the September jobs report yesterday. It was ahead of estimates, but not too hot, which again, for the latest data point that we've received, would indicate an overall level of stability in the economy, and therefore not a lot of activity needed by the Fed, which is good for markets. This next page here, I'm just going to talk about the general trend lines in the overall equity markets. Excuse me, again, touch on this for just a minute. I would start here, you can see that in 2025, whether we're looking at the Nasdaq, the S&P 500, world indices, the Dow Jones, even the Russell 2000, it's been a good year in terms of equity returns. And that's on top of equity returns in 2024 that were good for investors as well. And the point being there that when returns are good for investors, then markets are much more likely to be accommodative for IPO activity. The other thing that we'll cover here on this page just really quickly is just some time periods in terms of the dive that took place during the COVID era. We can see that, really, by the end of the first quarter of 2020, the equity markets really began to take off. In particular, the Nasdaq, we had really, really strong equity markets leading up until about the third quarter or so of 2021. And from that period all the way through, call it the middle of 2023, there was a lackluster equity investing environment by virtue of these indices. And, I'll come back to that in some of the next pages that I review in terms of IPO activity. What we can see here is that starting around the beginning of 2023, all the way until the Liberation Day activity and the new tariff regime, we've had really good equity markets as demonstrated by these indices. We took a real nosedive during the Liberation Day time period. But the soundbite is, and the implication for right now is that we've recovered very strongly since Liberation Day. And you can see that all of these indices have performed pretty well since that point in time. I would caveat that we've had some volatility, this week. We've had some volatility in particular yesterday as folks are wrestling with, AI investment, and also the notion that the Fed will not intervene by virtue of the jobs report. There was a lot of volatility yesterday. We'll have to see how it continues to trend. But generally speaking, over the last 6 months, we've had a very good equities market. From there, I'll just hit on really quickly where some of the performance has come from. And so, not surprisingly, if you look at the S&P 500 and its subsectors, it's been information technology, communication services, some utilities, industrials. You can see that things have been pretty good across the board, with the exception of, say, consumer discretionary and consumer staples companies. Again, as people, try to get a handle on how the consumer is going to do if we, enter into any period of volatility. And then in terms of the TMT, the technology, media, and telecom subsectors, not surprising here that semiconductors is leading the way, given everything we're hearing about NVIDIA and all of the other chip makers in the marketplace. So that's a little bit about where the markets are in terms of the indices, sectors, and things of that nature. The other thing that I would point out, which is good for the IPO market, is that since the August timeframe, some of the broader indices have really outperformed, in particular the Russell 2000, with the exception of the last several trading days and last couple of weeks or so, have caught up to some of the larger indices. And that means that more companies are participating in the run-up. And again, that means that equity investors are more comfortable in distributing funds across the equity markets as opposed to sticking to, a select few that we continue to hear about, in particular the Mag 7. And then I think a couple of other things to point out in terms of overall health of the market. Down here, you can see that in 24 or in 25, the growth at the EPS level has been very good in terms of the S&P 500. And we can also see that up here, valuations are getting a little bit overheated. And so if you look at a 10-year average forward PE multiple versus where it is today, there is a 22% premium. And I think we're starting to see a little bit of, not a little bit, some discussion in the marketplace as to whether or not we're overvalued. So that's a theme that's running through as well, and that has a little bit of implication for the IPO market. In terms of, again, health of the IPO market, one of the things we always look at is, the fundamentals of, cash available for investing. And, in particular, cash and money market funds is one measure we use to do that. I would say that, that number sitting at 7.5 trillion today is a good marker just in terms of cash available to put into the marketplace. So that is a good number. And then in terms of equity mutual fund and ETF flows, we also monitor this very carefully. You can see that, following Liberation Day, there was a lot of pull out of money out of equity funds. But since that point in time, which is helpful for the IPO market, it's been pretty stable. And, we have to keep this scale because this dip was so dramatic. But 3.2 trillion inflows most recently versus where it was earlier this year at 735. That means that people want to be in the equity markets. And so that speaks well for the IPO market as well. This final chart that I'll reference just relative to general market stability is for volatility. The lower this measure, the better. And we can see what the volatility measure was back in the COVID timeframe. We can see what the volatility was at Liberation Day. And volatility has stabilized quite a bit since then. And, a mark somewhere less than 21 is generally going to be good for new equity issuance, including in the IPO market. So again, just speaks to stability within the marketplace. Here on this chart is where we get to the actual IPO activity. And a few points to make here. You can see the dramatic run-up in IPO issuance in the 2019, 2020, 2021 period. I would say that there was, an incredible amount of euphoria, in particular, as you got into 2021. This was the SPAC era where SPACs were getting done. This was an era where companies could go public at a pre-revenue stage. And quite frankly, the IPO market got overheated during this time frame. I mentioned the doldrums that the overall equity markets were in the 21 to 23 time frame. And you can see how the IPO issuance fell off a cliff in the 2022 time frame. But since that point in time has been recovering. And, we can see that there's been some gradual growth. In 2025 thus far, there's been order of magnitude. This changes daily, somewhere in the neighborhood of 72, 73, maybe 75 IPOs in 2025. You can see that that's going to represent a meaningful increase over the level for 2024. So it speaks to a market that has opened up substantially since the 22-23 timeframe, but relatively speaking, nowhere near being overheated relative to this 2020 and 2021 timeframe. So again, a good measure of supply within the marketplace, and speaks to stability and decent new issuance, a decent new issuance environment. Just in terms of where these IPOs have occurred in terms of sectors, you can see here that technology has led the way, much like technology has led the way in terms of the overall performance of the indices. Financials, coming in a distant second, and then some level of activity across the remainder of the spectrum. But not surprisingly, there has been a dominance within the technology sector in terms of those those IPOs that have gotten done this year. In terms of the performance of those IPOs, you can see here that healthcare, there's some biotech names that are in there that have performed pretty well. Industrials, which is a general measure, has performed well. Financials have performed okay. And the technology sector has performed within a heavy IPO issuance environment. Not quite as well as healthcare, but it has performed. The one laggard really has been the energy and power sector. There are a fair number of renewables names in that segment. Those are heavily dependent on policy initiatives and things of that nature. And then there have been volatile energy prices as well. So that's a snapshot of where the issuance has occurred by segment. The next place I would go to is, how, excuse me, how deals have performed just relative to expected ranges here. And, we can see that, in particular, in 2025, in terms of the pricing range, 85% of the IPOs have priced either within the range or above the range, which is this 33%. And, when that pricing range has been established, they've generally priced at about a 5% premium to the midpoint. And then the aftermarket trading one day and then 30 days later has been very strong. So again, this is a good, healthy IPO issuance market. You can see here that only 15% of the companies that have come to market have had to price below their indicated pricing range. And that compares to, if you go back to when the market was not as healthy in the 22, 23 type time frame, 29% pricing below the range, 24% twice pricing below the range in 2023. And you can see that they were also pricing below the midpoint on average. So again, in 2025, for this type of volume, this type of pricing relative to the indicative ranges, in this type of aftermarket performance, it's been a good showing for the 2025 class of IPOs. And, along with the actual new issuance, the filings, here again, after, climbing substantially in the 2021 timeframe, because of the overall market doldrums, fell off a cliff in the 2022 timeframe. Those filings have gradually increased again, just demonstrating, issuers' comfort in getting filed and, getting dressed up, ready to go public when the window opens. I would say that, even though the filings have dropped off in this time frame, people are continuing, even from these cohorts of filings, continuing to keep their filings fresh so that, if the window opens for their individual story, they can hit the market window and get public. In terms of the backlog, you can see technologies is going to continue to be the largest segment of these filings that are on file with the SEC. And then about 81% are in other sectors. We also keep an eye on the private companies that, have expressed a desire to go public. That number is over and above the filing, standing at 242 as of, the date we printed this. But there's a, much heavier concentration of technology within that private company watch list. So that's a little bit about the IPO backlog. Again, it's growing, but continues to be relatively manageable relative to overall market activity. On this page, I just wanted to start to hit on some of the focus areas for investors as they continue to review the overall market conditions and then, assess IPO candidates. And these are some of the themes that are, coming through the market these days. I would say for these next few pages, this guidance is directional. It is not prescriptive. In particular, if there's strength in one area relative to others that can dominate, if there's weakness in a certain area, that can, have implication as well. But these are, themes that are out there within the marketplace for investors. And so if it's, top line visibility. So I mentioned previously that we were in an environment in 21, 22 where pre-revenue companies could, get public. That is by and large gone. And so top line visibility is an important dimension these days. Total addressable market and product differentiation within that total addressable market is important in terms of the market cap threshold. So once the company, goes public, again, this is a directional guide, but, really looking at something that's in the 3.5 billion type range. It can be smaller, certainly, for, those stories that merit it. Directionally 400 million of revenue. I'm going to come back to artificial intelligence, 20 to 30% top line growth. There's a concept of rule of 40 or rule of 30, or, which basically is indicating that your growth rate plus an EBITDA margin needs to be greater than 40. So 30 to 40 on, as a rule, growth rate plus EBITDA margin is directional guidance. Gross profit margin at scale, or, certainly within 10% of scale. And then in this environment, investors are looking through to, from gross profit or EBITDA margins into free cash flow, and really wanting to see a pathway to free cash flow break even within at least, call it 12 months from IPO. And then, a story that garners retail and aftermarket trading is important in this environment as well. I'd save artificial intelligence for last. And that's not to say that all platforms need to have, be, centered on artificial intelligence. But regardless of the platform, in investor meetings these days, the question of how artificial intelligence is impacting the marketplace, impacting your competitors, impacting your particular platform, and how you're winning with artificial intelligence is a major theme that is, running through the marketplace these days. So again, those are some directional, high level topics that investors are looking for these days. On these next couple of pages, we've just laid out a few IPOs that have gotten done within the relatively recent past. We'll talk about, some of the themes in terms of, the company platform, but then we'll take a quick look also at some of the metrics for some of these companies. And I won't, harp on the names as much as what the themes are. And so on this first page, whether it's Pattern, Klarna, Netskope, Figma, all of these were led by, a founder team. So that first bullet point there. There is the theme that's running through these as well is that there is a business enhancement. So e-commerce acceleration, streamlining, credit approvals, cloud security, and then, again, AI tailwinds just relative to software collaboration tools. And then finally, for each of these, it's profitable, expanding margins and cash flow. Klarna, 20+% growing GMV and improving take rate. Netskope, 33% trailing ARR growth with strong retention. And then with Figma, they weren't citing a rule of 40, they're citing a rule of 70, which meaning that the growth rate plus the EBITDA margin is in the 70% area. And another few companies, I'll stick to the left-hand side of this page because it continues the theme for the founder-led platforms. So StubHub and Via. StubHub, a huge marketplace relative to direct-to-consumer ticket sales, 25% growth, at the top line, and a large, here again, addressable market with the overall ticket value. Via operating in a market where they are modernizing public transit systems, again, a huge marketplace, 30% growth, and approaching break even at the EBITDA level. These other two situations I just wanted to call out because both of these were private equity backed in terms of being backed by buyout private equity shops as opposed to venture capital. And they were more established companies that the private equity firms acquired, did some operational improvements, and then have taken public again. And so they are larger in scale. They have a longer track record of operating, and so a little bit different fact pattern there. McGraw-Hill is a leading provider of K through 12 education content, and then Nick, that's the Nielsen business, and you can see here that for McGraw-Hill, EBITDA margins of approximately 35%, and then for Nick, mid-single digit growth, but with some leverage post-IPO. And again, that stems from the fact that both of those companies, were private equity owned. And then, the final couple of pages that I'll run through here just are some of the metrics relative to some of these deals. The first thing that I would point out is just the absolute deal size. So you can see in this column, we've got a range here of, call it $300 million IPO up to about $1.4 billion represented in these transactions. So that gives you an idea for, some degree of a sweet spot within the marketplace. You can see here that the majority of the issuance here was primary, 50% primary, 100% primary, until you get down to Klarna in Figma, where there were, it was predominantly secondary, so only 15% primary here, only 34% primary here. What I would point to is the linkage between that primary issuance in both of these cases versus the overall market cap. So where there is a much larger platform, there's an opportunity for a greater proportion of secondary shares. But you can see for the majority of these, it was either majority or all primary. In terms of the length of road shows these days, you can see here averaging 7 to 8 days. The market cap here again at issuance ranging from, call it 3 billion up to 22 billion. And then the percent of market cap sold, the maximum here is 16, 17%. So, there's a lot of embedded value with the company that was not actually sold to the marketplace. But this just gives you a feel for, how some of those items are trending. This next page just gives a scale on, revenue size here ranging from 616 and again, or I'm sorry, 381 for VIA up to about 2 or 4 billion. In terms of revenue size, you can see here that generally speaking, there's an expectation of at least double-digit growth. The more established platforms that were done in the private equity world have slower growth. All of these companies have, positive gross margin. 6 of the 8 have a positive EBITDA margin, and 5 of the 8 have a positive free cash flow margin. So again, just giving you some level of, view for these 8 deals, which are indicative of what's going on in the broader marketplace. And then, this page just highlights what the primary valuation metric was in this first column here. So you can see that it's either EV or enterprise value to adjusted EBITDA, or revenue or enterprise value to gross profit. You can see that, here, again, going back to that 2022 class, there was a lot more EV to revenue, and what the market wants to value today is some measure of enterprise value, primarily to profitability, whether it's gross profit or EBITDA. And then you can see what the valuation was at the midpoint of the indicated range versus where it actually got priced. And so, again, just speaking to the overall health of the market, the indicated valuation in the range was 13.9. Here it priced at 13.9. This deal priced up, this priced in line, this priced up, this one priced up, this one priced up. The only 2 that priced behind the indicated valuation range were the 2 private equity transactions. And so, that is it for the IPO market. I did just want to leave one last page and just, illustrate that in the private capital markets, The trend lines tend to follow very much the equity indices, and then the actual IPO issuance as well. So we've seen a lot of new issuance in private capital within the last several years. 2025 is going to be a banner year. And importantly, not only are we seeing a lot of capital, but we're seeing a lot of large deals get done as well. So 43% of the capital that's been raised thus far in the private markets has been raised for deals that were $1 billion or more. And you can just see the size of that lavender bar relative to the others as we progress over time. But again, the strength in the equity indices, the IPO markets means that the private capital markets has been strong as well. And that's really it. So with that, Colin, I think I'll turn it back over to you to introduce the next panel. But absolute pleasure to be able to spend some time with folks today.
Amazing. Thank you so much, Bruce. Before I let you go, there's a couple of questions in the Q&A box that I'd love to see if you have an answer for. One is, are SPACs still a viable option?
SPACs are struggling mightily these days. So I would say unless it's got, a real magical theme to it, either the SPAC itself or the de-SPAC proposition, those are very, very difficult to get done these days.
Great. And then another question here. You touched on this on one of your slides a little bit, but it's saying evaluations are overheated because of AI evaluations, correct? How have VC inflated AI evaluations impacted IPOs on your side of the business? Or is it too early to tell?
We are getting to the point at this point in time where people are really recognizing some degree of overheating for the AI valuations. So up until this point, it has not been a huge influencer in the IPO marketplace. So the IPO pricings have been strong. Folks have not been, too worried about, overheating with AI. What I would caveat that with is over the last week or so of trading. And so the volatility that literally we saw in the marketplace yesterday, because of the speculation of, AI becoming overheated, if that starts to wind its way through and we see that, multiple weeks in a row, we will see that volatility translate into a slowdown in the IPO market, would be my suspicion.
Awesome. Okay, one last one. Could you please provide your IPO outlook for Q4 and 2026? Nobody has a crystal ball.
I would caveat it by saying that if the economic indicators that I had on that first page bear out, meaning that GDP growth is in a range of somewhere in the neighborhood of 3.5%, and we continue to see an environment whereby the Fed is saying we're in a decent spot relative to inflation and unemployment. The Fed does not have to be overly active. Then, my outlook for the fourth quarter of 2026 would be about what it is today, meaning we've got a pretty healthy IPO market, pretty healthy, equity market as well. And so we would look for, that level of stability to continue its way into 2026. And I would caveat that with, just, posing the question back to folks. Imagine everything that can happen between today and a year from now, from a geopolitical perspective, from AI perspective, and things of that nature.
Oh, amazing. Well, thank you so much, Bruce, for joining us, for sharing those insights, and for bringing a bit of optimism to the table today. Really appreciate the time.
Sure thing. My pleasure.
Alrighty, well, thank you, Bruce. And up next to our attendees, please join me in welcoming our next panel to discuss IPO readiness and legal considerations. We have Liz Beyer, partner and founder at Class B Group. We've got Erica Whitmore, partner at KPMG, Austin March, partner at Wilson Sonsini, and our moderator, Roberta Burrows, board member at the Nasdaq Entrepreneurial Center. Hello, everyone.
Hello, Colin.
All right, well, looking for this. Over to you, Burrow.
Thank you so much, Colin. So welcome everyone today. Really looking forward to this discussion. What I'd like to do first is just have our panelists each introduce themselves. What I'm going to do is we're going to start with Liz, then Austin, then Erica, and then we will get the panel started. All right, Liz, over to you.
Let me jump into it. Bruce's slides were terrific. I run an organization, founded and run an organization called the Class 5 Group. We are an IPO advisory firm, and I founded that firm having been an institutional investor with T. Rowe Price for a long time, having been an investment banker, having been a public company board member, and having been one of the project managers of a very large, unusual IPO a number of years back. So having been all around the table on the IPO process, I now work with management teams as they're going through the process to help them understand all the nuances and control everything that they can control.
Yep, I'm Austin March. I am a partner in our corporate and securities group at Wilson Sonsini. I sit in Austin, but I've got a national practice where I represent late-stage private companies who are looking to access the public markets through a traditional IPO, a D-SPAC, excuse me, a D-SPAC, direct listing, and then once you're public, you're subject to a bunch of new rules and obligations, and I help them navigate those from a compliance, from a board perspective, as well as whenever you access the capital markets later. We help them through that full cycle.
Thanks,
Right,
Austin.
Erica.
I'm really excited to be here today, and thank you, Bruce. That was such a great update. We appreciate that. But my name is Erica Whitmore. I'm an audit partner and also managing partner for our Salt Lake City office. I've done quite a few IPOs throughout my career. I've been with KPMG for about 26 years, and just really happy to be here. And always love, Liz, we can talk more offline, but I always love helping companies get ready to go public. I think it's one of the most fun things that you can do.
All right, great. Thank you so much, panelists, for joining us today. I have a first question that I would like to extend to all of our panelists. We talked a little bit in terms of Bruce's update about how the current market environment is changing, but could we kind of double click on that a little bit in terms of how that current market environment has changed in 2024? What are the expectations for companies considering an IPO? And more specifically, if you are a founder who's intending to go public within the next 12 to 18 months, what are some of the high priority items you should be focused on? So Erica, since we ended with you, let's start with you on that question.
Okay, thank you, Roberta. I think that hopefully, and this is what we're seeing in our client base, a lot of companies have had a little bit more time to get ready, right? So because in 2024 the IPO market was down, 25 we started seeing it pick up, and as Bruce said, it's doing quite well right now, but still not to 2019 levels. So in our particular situation, a lot of our clients have taken that time to really get ready, to really focus on those profitability metrics and making sure that when they do see the window is open for their particular company, and I think a lot of that depends on their industry, their comps, if they've had anybody that are similar to them that have gone public, how have they performed in the market subsequent, right? But really make sure that they're ready, right? They're ready with their governance process. They're ready in terms of being able to forecast, even if they don't plan to communicate to the street what their forecasted numbers are for the future, but really taking the time to put the right systems, people, and processes in place to make sure they not only can go public, but be a successful public company once they go.
Thanks, Erica. Liz, would love to hear what you have to say about this subject.
Yeah, boy, there's a lot there. Looking ahead, Erica nailed it. The decision it often depends on valuation, and valuation often depends on what the public comps are doing. So when the market's up, people are all excited and think they want to go. When the market's down or volatile, as it is now, they are less enthusiastic. I think there was a question that came up to Bruce about what do you see for Q4? The SEC shutdown really took some companies that thought they might go before the end of 2025 and kick that can into 2026. There's a very long process, and you need SEC approval for your documents. And if there's no SEC, there's no SEC approval, ergo fewer IPOs. So I think there is moderate enthusiasm for 2026. I don't think that everyone is racing to get out the door, despite what I just came back from an investment banking conference. Like, it's going to be great. No, I think it's going to be good. I have defined the last couple of years when people have asked. I've said on a 1 to 10 scale, the last couple of years for IPOs have been about a -5. We're up to 3. But that's at least that's how I would answer the question about what's the current environment. Things are getting better, but let's just all remain calm because, as somebody's pointed out in chat, a number of the IPOs this year, most of them, in fact, aren't performing as well as the overall indexes. And so we can get back to some of that later, but let someone else take a shot at this.
Yeah, that's bearing itself out in the legal process as well. It's not just, in 2019, you'd have an org meeting and then 4 to 6 months later, you'd be public and everyone was really excited about it and you're off to the races. Now, it's a longer process. You really need to be thoughtful about engaging people early and working through all of the issues kind of behind the scenes through, working through the disclosure with the SEC. And then, as we're seeing right now in the market, there's a 15-month gap between the initial submission of the draft registration statement and the effectiveness. And so that's much longer than 4 to 6 months that people were targeting, a couple of years ago. And that's in large part due to a few contributing factors. The market window, as we've talked about, is, questionable. And so you need to be ready to go whenever the market window opens, which means, you get ready and you're all dressed up for the ball. And sometimes the ball is going on, sometimes it's not. And you have to be ready to go whenever the dance starts. Another thing would be, making sure that your financial statements are prepared. And sometimes that, as Erica, I'm sure will go into in great detail, that can take a while to get done. And then also, what we're finding is that a lot of, at least our clients, are going through multiple rounds of testing the waters meetings. And, investors don't want to just see and meet the management team once. They want to hear how the company's doing. They want to understand the story. And then they want to say, okay, we met you 3 months ago. We met you 6 months ago. You said that you do X, Y, Z. Did you actually perform on X, Y, and Z? Because we want to see a record of success over that period of time. So, it's not that the market is closed. It just takes longer and you need to be more thoughtful and plan ahead.
Thank you all for that. That was really, really comprehensive. And kind of to double click on what you were talking about, Austin, particularly that 15 to 16-month window versus that 4 to 6-month window that people were used to. Erica, specifically wanting to ask you, what are some of the financial metrics and KPIs that public market investors will scrutinize these new companies as they come to market, like in 25, 26?
Yeah, and Bruce covered this pretty well too, right? But I think, Roberta, obviously revenue, right? But also revenue growth. And then, like Bruce said, like the total addressable market, right? So I think really making sure that you not only have a pretty good history of your revenue growth, but then also what does that look like and what is your competition like, right? Are you going to be able to take the market share that you're anticipating to be able to take? And then also, this is, I think, a little bit different. And again, I'm going to mention Bruce a lot because I thought he did a really great update. But I think if you look back to like 2021, totally less focus on profitability, right? Whatever that means for your company, depending on what industry you're in, you need to be either profitable, have a really, really good path to profitability, and like Bruce said, also free cash flow, right? So to me, what that has done, I think personally, my personal view, is that has made companies much more stable and much more, they have a track record, but then they also have a really good story as to how they're going to get to the next level and really give those returns to investors that are willing to invest, right? Willing to invest in their initial public offering. And so those are super important. And one thing actually, when Austin was talking that I wanted to make sure that I brought up, AI, and I might be getting a little bit ahead, Roberta, so I apologize for that, but AI has to be part of your story. It doesn't mean it has to be part of your product or service offering, but you better be using it in your back office, and you better be using it to optimize everything that you're doing, right? And maybe that's not part of the story, the equity story, quote unquote, but it will be part of the story, as Austin talked about, in talking to your potential investors, right? And like Austin said, like, not only here's what our initial plan is, here's what we're doing, but then here's what we plan to do, and then come back and then here's what we've done. So those are some of the things that I think companies are pretty focused on.
And if I'd love to jump in and add two more metrics, because what Erica said was spot on, but particularly in the tech side, this would not include the data center folks, but there's something called NRR and GRR, net revenue retention. Of your customers who were with you last year, how many are with you this year? And what are they spending? If they spent $100 last year, are they spending 98 this year? Or are they spending 120? That is an incredibly important metric for investors. And the difference between net and gross is Xing out the customers who came for a year and said, nope, this product is not for me and went away, which is net versus in total. But NRR and GRR, and people use different initials to describe it, but who's coming back? How much are they doing this year? If you sell more than one product, did they come in for one? Are they now using two or three? Huge issue for, again, on the tech side, on the software side in particular.
Liz, I love that because I had that in my notes and I missed it. So thank you so much. You're awesome. Thank you.
Teamwork.
Awesome. Awesome. Austin, do you have anything to add to that?
Yeah, I think there you need to have an idea of the metrics that you want to put out, but you also need to be responsive to what investors are asking for. Because, you can say these are the three things that we really value our business on. But if investors say we need more detail on these other three things, then you need to be able to pull those together quickly. And so it's not just seeing what's the message we want to give, but also what are, real-time feedback, and being able to calculate those on a consistent basis is super important, so that you've got support for all those numbers. Because through the IPO process, on the legal side, one thing that you have to do is you have to show support for all of the numbers that you put into the S1 or the testing the waters materials. And, it's great that you've got numbers that you can put into a slide, but if you don't have support for all of those things and it's not calculated consistently across periods, then you're going to run into issues as you're trying to put this information out as part of your IPO.
Great, great. And I'm going to ask one more financial question, then I'll get into like more stories-based questions, governance structure questions. But Erica, and everyone here, we obviously talked about the metrics and we talked about NRR, GRR, but I also was wondering, I'm going to kind of adjust this question a little bit, but do you think that founders, their approach now for financial reporting, things like GAAP compliance, internal controls, because there is this push for profitability, are they coming to market already having those controls in place? Or are you seeing that there's a lot of leverage, or I should say upside, that you're having to get them to a certain point before they go public? Are they still operating in that scrappier startup mode, I should say, versus really being public ready?
Yeah, and I'll love to hear Liz and Austin's response to this too. I mean, our experience has been they are absolutely 100% ready, right? And in many instances, again, I'll just speak to our client base specifically, but those companies actually really wanted to go public probably maybe even a year ago. And again, there's some others, right, that are preparing for like I think was mentioned maybe this year and now not, right? But next year, I think Liz said that. But really, they are ready, right? They have worked with us or another provider to help understand early on what are the gaps, right? And what are we doing to address those gaps? Here we are as a private company. Here's where we need to be as a public company. What does that mean in terms of the audited financial statements? Making sure, depending on what type of filer they're going to be, they might have time before they need to have an internal controls opinion from their auditor, but they still need to be able to speak to their internal controls, right? So making sure that those are put in place. Same with governance, right? Making sure that they've got the right board members, the right number of independent members, if they need an internal audit department, and the timing of that. So, not to get too far into the weeds, but again, our experience has been that companies have taken the time to make sure, again, they're not just ready to go public, but be a successful public company. I mean, one of my partners years ago, and I really hope he's listening, he always told me, it's not just about, having the child, it's being able to raise the child, right? So you have to be ready for both, and both are complicated. In fact, raising the child is a much longer period of time, right? And you need to be able to have processes in place that are sustainable, right? And repeatable. And the other thing I learned on the first few IPOs that I ever worked on, this was years and years and years ago. Now I'm just old. but was to you never want the accountants to be the surprise, right? Or the holdup. I'm sure Austin has many stories for this. But really, again, prepare. And now I'll stop there because I know Liz and Austin have some good thoughts too.
Well, I was going to jump in and reference Austin's 15 months. Just taking it up a level, one of the questions is, how does a company know if it's ready? And the answer is nobody's ready. You haven't gone through this before. That's why you take 15 months to do all the things that Erica just referenced, because you've been running like a private company, and the things that have been important to you have been growing the business or hiring the right people or figuring out what the go-to-market strategy is. You haven't been focused on SEC reporting and closing the quarter in, ideally 10 days, which nobody's ready for when they go, but you will be eventually. That's what the 15 months is about. All of these steps along the way, but there is no magic answer to how do I know if I'm ready? The big piece there is, do you have the right people in the right seats? Have you started to do your audits? Because those do take a long time. And do you have some level of comfort with your ability to forecast? Because once you're a public company, you can't miss a quarter. But sorry, Austin, I'll let you have the floor in 1 second. But Eric is spot on. It's going public is hard. Being public is much harder. Be ready.
I agree with all of that. You got to dress for the job that you want. And if you're going to be, the most successful public companies are the ones that act like public companies before they're public. That is across all functions. That is not just the C-suite. That is, everyone within FP&A, everyone within accounting, everyone within legal, taking the mindset of, we're not just a private company that is only accountable to ourselves. We are now a company that has measurable goals, that we are accountable within the organization and externally, and making sure that you have the right system and oversight in place to do that is before you get to be public, makes the transition much easier. Because as Erica and Liz said explicitly, this is just the beginning of the race. It's not the end.
Very true. Very, very true. Liz, I'm going to pivot a bit and ask, how can founders begin shaping the story and equity narrative investors expect well before the roadshow?
So important, and particularly important in the era of AI. You want to go public. Every investment bank wants to help you go public, and they're all going to compete for your attention. And in the era of AI, and even they were doing this before, but now they're not having the junior people do it. They will show up at your doorstep and say, look, we've already written your document. We've written your S1. Here's your story. Ixnay, you do not want outsiders to tell your story. You need you to tell your story. So as soon as you start thinking that you're going to be a public company, you need to start thinking how you want to tell your story. And the most important parts of that from an investor's perspective are, what are the 4 or 5 or 6 things that you do better than anybody else? What are your competitive strengths? And what's the stack rank order of them? And again, that's something nobody thinks about when you're a private company, because who cares? But what do you do better than anyone else? What will be your proprietary sustainable advantage? Matters a ton. The second thing that matters is, how are you going to grow? Are you going to add new regions? Are you going to add new products? Are you going to add new customers? Are you going to add new products for your existing customers? You're probably going to do all those things. Again, what's the stack rank order? How are you going to spend your resources to accomplish those different growth trajectories? So start thinking about it in the gym. Start thinking about it when you're out on a walk, and begin to map how you would like the world to know your story, because you'll put it in the S1, as both Austin and Erica will attest. And then from your S1, you'll end up putting together a slide presentation to go out and meet the investors. And from that slide presentation, you'll put together a roadshow video. And then you have to live with it, because investors are writing things down. And 3 months later, and 6 months later, and a year later, they're going to say, hey, you said X. Did you do X? So it literally is, do not let outsiders do this for you. We'll all volunteer to do it. Don't let us. You do it, right? Just get the outline together of what's critical for why you're going to be a big winner.
Thank you. Thank you, Liz. And kind of to focus in more from the legal perspective on that, Austin, from a governance structure perspective, what should early stage founders start implementing long before the S1 draft?
Yeah, so I mean, as we've talked about, preparing for an IPO is a cross-function exercise. And I'll quickly touch about legal, but like it's not just legal, it's accounting, as Erica will talk about. It's, getting your process in place to close the months and the quarters, establishing the appropriate internal controls. You get the finance functions where it's like, hey, evaluate KPIs, measure them, hit them. The founders need to be thinking about board composition. And so it's everybody. It's not just legal. But from a legal perspective, there are some things that you probably want to get started with early. That would be, working with your key stakeholders and figuring out if you're going to have a dual class structure. Because, a lot of, at least in the tech space, where there are founders that hold a significant portion of the stock, once you're public, you don't necessarily want to give over control to the public. You say, you're investing in this company because you're investing in me and my vision, and I don't want to dilute that by giving away too much control. And so you say at the IPO, even though we're giving away 20-30% of the company, those shares are not going to have the same voting power as my founder shares. And you want to start thinking through if that's a structure that's really important to you. And if so, what parameters do you want around that, those securities? In addition, we'll talk about this probably a little later, but you need to get the right board in place. And that's not just thinking about the right skill set, the right people with the right Rolodexes, the people who have access to capital, but it's also making sure that you've got the right levels of independence and qualifications for expertise for accounting or for the audit committee. So you want to have a board that is majority independent. You want to have a board where you've got enough independence with the qualifications to serve on comp, audit, nominating, governance. And that takes time because you want the board relationship to be mutually beneficial. You want people who give you appropriate oversight and can guide you where you need some guidance. But you also want to have the board that you can call upon and say, hey, I don't know, let's go. You also want a board that you can call upon to say, hey, we're having this tough issue. We need to get an in with this customer. And you want to have a really good relationship with those people. And that takes time to figure out who those people are. In addition, from a legal perspective, you want to start thinking about diligence. You need to populate a data room with a laundry list of things and getting that list early so you can start compiling that information, sifting through what's important, what's not, what's going to be impossible to pull together, but what will just take some time. As well as you're pulling it together, it's like, gosh, some of this stuff is really sensitive. What kind of parameters do we want to start thinking about putting around it for giving it externally? And how do we want to start, thinking about the responses when people say, oh, tell us about this litigation. Tell us about, this IP issue. You want to have responses to those questions before they're asked. And that requires, working with your advisors to make sure that everyone is knowledgeable about the situation and what the answer is. And then also just thinking about areas of sensitivity. Do you have any related party transactions that, people will say, that's weird. I heard about WeWork. Like, tell me more about this. Or, do you have funky compensation arrangements that you need to justify or start thinking about how to change? Thinking about what those areas of risks are and those areas of sensitivity and start working those through. So either they're not areas of sensitivity whenever you start putting together the S1, or you have answers for why, it's an issue, but we've solved it.
That was extremely comprehensive, and I think exactly the type of detail that we wanted in this type of answer for our teams and our founders out here to really understand what's necessary, particularly from a legal perspective. Erica, we talked more earlier about from a financial perspective, but I know from an IPO readiness versus SOX readiness, you talked about some of the companies that had things in place. Can you go into some of that detail too for our audience here?
Yeah, absolutely. And real quick, just to build off of what Austin was saying, some thoughts that kind of came to mind I wanted to share. Roberta, I think, working with a reputable large firm, I don't want to say it has to be Big Four, but I do see that most often with companies that go public is working with the Big Four, right, as your auditor. And I do think, again, that process can take time depending on whether or not you have been audited. And if you have been audited by what, size of firm, I think that just matters, right? And really making sure that, your footnotes and that everything is compliant, right? Is GAAP compliant with PCAOB standards. So that can take time. So again, kind of building that in, hopefully, as a private company, I mean, usually we work with companies pretty early and help them kind of get ready for that years and years in advance, right? So I think those are really important things. But also making sure that, sometimes accounting you would think is black and white, but it's actually not, right? There's gray areas and there's areas that the SEC will pick on, right? And so kind of back to Austin's point, if you've got some of these, compensation arrangements and or related parties that are maybe a little trickier, those are things that take longer to work through. And we want to make sure that, we're aligned with the company and how it's presented and making sure that it's just very easy to understand, because sometimes some of those things can catch investors off guard and add time to the process, which nobody wants, right? So again, I'm just continuing to beat the drum of get your advisors in early, make sure you've got the right seats at the table and that everybody's getting ready. In terms of your specific question, Roberta, to IPO readiness versus SOX readiness, again, depending on what type of filer you are, you will have time before you need, an opinion from your auditor. That being said, you want to make sure that there's no surprises, right? So you do want to put those internal controls in place early, well before you go public. One mistake I see, and I'm actually stealing from one of the questions later, Roberta, I seem to keep doing that. One thing I see companies that are getting ready to go public do very often and is very taxing on their team is doing a system implementation at the same time, or not very long before going public. And again, I get it, right? Sometimes it's because, well, we didn't need it prior to going public. Great. But if you don't, again, put the right resources in place and make sure that people don't get burned out, mistakes are going to be made. It's not going to be done as well as if you had had time to plan, make sure you put all the right, accounts in place, et cetera. Just something that's super important, and that the internal controls over those systems, again, back to your SOX readiness, super, super important, and something that I see often just cause problems, right? If you don't kind of put those controls in place early on. So Roberta, that's what I'd say. I bet Liz has some comments on that as well.
Yeah, and I was going to pivot to Liz, but I do want to say that this is meant to be an organic conversation. You probably noticed I've been jumping around in terms of questions and making up new ones, and just really making sure that we can provide and ask things that make sense with the conversation that we're having here with all of you today, because we're just so pleased to have you. But Liz, opening up to you. And Liz, I want to say before you start, and I know you have a lot to add, from a mind shift, you mentioned, get ready, buckle up. And people have said this when I was working at Nasdaq, and I know teams before it was Meta, it was Facebook, people have said that Mark Zuckerberg is one of the better founders who has made a really good transition from being a founder to a leader and running an organization. I would love to hear your perspective on what that mind shift needs to be for founders in a leadership realm. And then we'll go to Q&A.
I love what you just said about shifting from being a founder and a leader. You're a founder. You built this from nothing. You have this cool company. And by the way, you probably didn't listen to advice from other people, because if you did, or at least from many people, because if you did, you wouldn't have done what you did. Like if you're a founder, entrepreneur, you're a little unusual anyway, and 50 people said to you, you can't do that, and you did it anyway. So generally speaking, I find the founders are pretty sure of themselves because they have a track record to back that belief up. It becomes more difficult to be completely self-reliant when you are running a big company, and I see that as a problem all the time in the technology space. People who've been wildly successful don't want advice from anybody else. So what's different? And this is true when you take venture capital too. When you take venture capital, or when you go public, you are making a commitment to those new owners. You're going to have an exit. If you didn't want their money, it doesn't have to be an IPO. It could be M&A. It could be anything. But at some point, there will have to be an exit, or you have to buy them back out. And the same as an IPO. You have new owners. new shareholders and they own part of your company. They got a part of your company, you got cash. It was a very clear transaction. What are the things that are important to them? Now, you can't listen to them all the time because they want more, more, more now. I'll give you an example. Way back machine, when Google went public, the big competitor was Yahoo. Yahoo had this if you typed yahoo.com, the front page had all kinds of stories and all kinds of advertisements and a whole bunch of stuff. And if you typed in Google, as you mostly do today, it was just that box that said Google. And investors screamed and yelled and said, no, 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 you're wasting all that asset of the front page. You could be selling ads here. And the Google founders said, nope, not going to do that. Thank you very much. We think it works better because it's plain and simple. And in fact, that was brilliant. So it was a case where they didn't listen and they were absolutely right. But there are other things, particularly about some of the things that Erica and Austin have mentioned about legal responsibility and accounting responsibility that may strike you as stupid. Why do I want to do that? But you have to do it. It's part of the trade-off. So the mindset is, I don't control everything anymore. We can talk a little about dual class stock, which is increasingly popular, but I don't control everything anymore. And I have to be aware predominantly of the long term. I am running this business for what is in the very best interest of my shareholders over the long term, even if that means a bad quarter or two, but everybody buckle up because those are no fun. But you do have a different set of owners, of people to whom you are responsible. And that's a challenging mindset shift for many founders who got to where they are based on their own internal compasses.
Yeah, and just to add to that, the founders realize that being public comes with a bunch of new rules and obligations, and that's all great. But I've seen Elon Musk talk, like he doesn't seem to agree with all that. He just says whatever's on his mind. Elon Musk is one of one. A lot of public companies and their investors expect their CEO to behave in a certain way, and they expect their management team to be buttoned up when it comes to what they say, when they say it, how it's said, run things by legal, and changing that mindset of saying things definitively to saying like we believe or we expect, and making sure that there's support for all those statements. That kind of process building takes time, and for better or worse, now we're seeing 15 months between draft registration statement to effectiveness. You've got time to get that internal mechanism working, but that does require a mindset shift of limited set of potential risks or liabilities whenever you're a private company to being a public company, and you've got stockholder suits and real risk. And that's why D&O insurance costs so much more when you're a public company. And so changing that mindset and understanding that, it takes time, but it is very important.
And I'll toss in, I'm stepping on Austin's toes a little bit here, but a tangible example of that is get off of social media, right? Stop expressing your political views. You may have them, you're entitled to them. It certainly won't help your stock because half the people will think, he's awesome. And the other half will think, what a moron. Or my favorite story is a CEO who was also a hunter. Okay, people can be a hunter. And he liked to post photos of his kills or whatever the right technically correct phrase is. And he did, in fact, during the IPO roadshow, he'd been hunting in Connecticut and he got a deer. And he put a picture of himself standing there with his deer. Unfortunately, there was a sign in the background where he was that one of the investors recognized as being on his own property. So this founder CEO had been poaching on a property that just happened to belong to an investor who saw it, and they went after him for felony trespassing. So anyway, just you have to change the way you interact with a much greater public.
That was an excellent story in terms of ensuring that people understand just how large their reach can be when they start thinking about becoming a public company. I have no words for that because it was just spot on. In terms of, I know we're kind of getting close to questions. Colin, I don't know if you're there. I think we have a lot, but I do want to do the rapid fire before we go
You're
into
doing great
that?
on time. Yeah.
Okay, all right. So let's go. Rapid fire. One thing to start doing today. Erica.
Just start getting ready. I do think that if it's a path that you're on, like I mentioned earlier, really understanding where you are today and where you need to be, and then prioritize that list is super important.
Austin.
This will be self-serving, but you need to engage advisors early. To Erica's point, you need to get going, but oftentimes you don't know where the going is you need to get to. You need to engage the right folks, and that means, talking to your board, talking to, your contacts, making sure that you're talking to the right law firms, accounting firms, third-party advisors, so that you can understand what you should be working on now and what the timeline is for getting all those things done.
Liz.
Agreed with everything that was just said and with the talk about get your audit going and get the right board. Know why you want to do this. It's a long, challenging process. You don't have to go public, particularly in this environment. There's so much private money out there. Why do you want to go through this? And there's some really good reasons, but you better know yourself before you dive into that pool why you want to go swimming.
And Liz, other than making sure that if you're hunting, you're not hunting on your investor's property, what's one thing that you should stop doing today?
Stop telling people what your numbers are. Keep them in your back pocket. This doesn't apply for companies that are pre-revenue, but if you're doing 200 million in ARR, tell people you're doing more than 150. Keep some surprises for the moment when you're actually out there raising money, and don't hype the business. Be factual, but not, we're going to be the greatest, whatever. And I think Austin said this, stop using the word will and start using the word may or could or aim to. But really keep some financial surprises to yourself.
Yeah,
For
I
now.
would say,
Oh,
I
go
would
on,
say
Austin.
that you need to stop thinking about the IPO as a finish line. I mean, it is an incredible milestone for a company. It's a transformative event. But it is one event and hopefully a very long timeline of success. And so going into it with that mindset and saying, we want to be a successful public company, not we want to be a public company, is paramount for the success of the business post closing the IPO once you've rung that bell.
And you'll see a common theme for me. I think it's stop being short-sighted. We've all talked about that. There clearly is a time when you literally just have to focus on the business in order to get it to a size and scale that you can actually think about going public. But I think really having a long-term mindset, if you have to put in resources last minute because all of a sudden the market opens, you won't get the ones that you want. So I think just thinking really long-term, and again, start planning, what are those pieces I need to put in place? And back to what Austin said a little bit ago, what's the timeline associated with that so that you can start putting those pieces in place really before you need them.
We have one rapid fire. I'm going to change it a little bit, actually. So it says initially one thing to prepare for sooner than you think, but I wanted to ask, what is one thing that you think you can delay?
It's like
Anyone want
counterintuitive, Roberta.
Okay.
I mean, I don't know. I would love Austin's thoughts on this too.
One thing you could put on the back burner, I should say, right? Everything's important, but
Yeah, internal audit, I think, is something you can pump the brakes on a little bit depending on the timing.
External investor relations. You'll have a moment, but there's not a lot of relation you can have with investors except under very strict rules, and people spend way too much money way too early, often hiring IR too soon.
This is entirely a cop-out, but I think it depends on your circumstances. Some companies, you really need to clean up a specific compensation arrangement or a loan with an officer. And you should focus on that early because it's a problem for SOX purposes. But some companies have appropriate compensation provisions in place. You can punt that until later on in the process. Some companies have, a great board that is ready to go, prime time. Let's roll out the IPO. Others, that is a major work stream that needs to be done immediately. And so you really need to take inventory of what's going on at your company and where your areas of weakness are. And that's where, having good advisors can help you say, hey, here's a 40, 50, 80 page deck on IPO preparedness. Let's start talking about it. And as you go through it, an hour, it might be an hour, 2 hour, 3 hour discussion. All of a sudden, out of nowhere, you spend most of that time on a few specific issues that are, most important to you. And so identifying those early and starting addressing those early is super important to having a successful IPO, because then you're managing expectations. Everyone knows, okay, these are the 3 areas we really, really need to work on.
Roberta, can I throw in one more thing that is
Absolutely.
super important? And that's, if you think you want to go public, try to keep it to a very small group of people within the company. Because once your employee base understands you want to go public, they start getting very excited about what's ahead, and they think about timing. And as we've discussed, timing is very unpredictable. And you don't want folks dreaming of their Ferrari or the new house until it's tangible. And I will say, I was in an investor meeting early on with the founders of a significant company, and they were talking to a very big deal investor who's been very, very successful. And literally one of the early questions is, once we're public, which kind of jet should we get? Don't do that. Okay. Don't count your chickens until they are in your wallet, but also keep it incredibly quiet within your company, because expectations get out of control and can work against you.
Okay. I know, Colin, we have a little bit of time, but I'm going to ask one more question just because you brought it up, Austin, and I thought it was really relevant, and this is to all of you. But what are some of the specific things that you've seen, and you can each talk from your specific expertise realm, that have delayed IPOs?
A lot
Austin,
of
you're
things have
Erica said you had some stories. You brought it up, so I figured I would just ask.
You're like, I want to hear those stories.
Yeah, I'm obligated by attorney-client privilege, so I can't share all the details.
Yes,
But there are a lot of things that you can control, and there are a lot of things you cannot control. You cannot control when the market window is going to open. You can't control what's going to happen with AI. You can't control how long the SEC is going to take. You can't control when a global pandemic is going to happen. There are a lot of things that are outside of our control, but there's a lot of things that are within your control that you should be working on now. And getting the right management team in place to oversee those various functions and having the right skill sets, whether it's like making sure that you've got a CFO who's a public-facing CFO who knows how to do the job of IR, managing an accounting function, managing a reporting function, getting those people in place and being able to delegate, especially founders who are so used to being in the weeds and controlling all the decisions. I have seen many circumstances where founders struggle with, letting go of some of that and really delegating to their teams, but also knowing when to step in. And so making sure that you've got a good sounding board. And frankly, I think something that is really, really important is, if you're a founder or you're in a leadership position, have somebody who's gone through this process before at another company who you can call upon and say, hey, I'm working through this issue. Help me, you've seen this before, you've seen something like that. Let me utilize your experience, your network to try to think through how to solve that here. And so getting that kind of mentor relationship, and you can get those, depending on your function, whoever you're working with, your outside service providers, we've got clients, all these people, all these great panelists have clients who can help put you in touch with good contacts so that you've got an internal network that you can call upon during the process, because things will come up that you can't control that you're going to have to work through real time.
Roberta, Austin's answer was fabulous. The one thing I would throw in is, because your question was what delays you. So these are two very public examples, one that did delay somebody, one that didn't. But media, be careful what you say to the media. For instance, maybe you don't want to give an interview to Playboy right when you begin the process. Google remains the only company that ever has an entire Playboy interview attached to the back of its S1, which we like to joke means people read our S1 for the articles. On the other hand, they did not get delayed. We did a lot of fancy dancing with the SEC, and we did not get delayed. But Salesforce did because Mark Benioff, way back in the day, decided to let the New York Times follow him around on his roadshow. And the SEC said, yeah, no, see you in 6 months. So be very careful in what kind of hyping you do to the media if you don't want to get delayed.
So Roberta, my answer is probably going to be more boring than both of theirs, but two things, right? Related party transactions, and again, I can't say too much because that just wouldn't be right. But meaning like, I think what either Liz or Austin mentioned, if there's loans between executives, if there's loans between the board and executives, those types of transactions can really slow things down at the time when you're a private company. They may have been allowed, not as big of a deal, et cetera, but for those to be discovered during diligence or a whistleblower or things like that, it's just never pretty, right? And can slow things down. The other thing I would say is just really, and we haven't actually talked about this, but really making sure that your contracts are kind of under control. And Austin, I'm not trying to get into your area, but from an auditor perspective, having your arms around your contracts, hopefully you have a contract management system or it's part of Salesforce or however that works, but making sure you have all of them and they've all been considered by both, by everyone, right? By yourselves, making sure they're properly disclosed if they're required to be disclosed, and then making sure that the accounting team has evaluated, all the implications, disclosure and accounting wise. So
Yeah, you don't want to have a situation where you close an IPO and the CFO said, "Oh, I signed this agreement with this underwriter. What do I do with this?" Say, that is not where you want to be. I agree with that wholeheartedly.
Thank you all so much. I think this was an excellent conversation. We're going to transition it to Colin now for a live Q&A.
Awesome. Well, first off, Liz, Erica, Austin, amazing job sharing real life stories. And Roberta, as always, thanks for leading such a great conversation. There's some great questions in the Q&A box, so we're just going to get to them all. And if you haven't dropped your question into the Q&A box yet and you have one, please do so. We'll try to get to them all. Alrighty. This one I'm just going to pitch into the ecosystem. Up first is thoughts on a 2027 IPO in healthcare.
I don't work with healthcare companies. I don't know.
Yeah, I think trying to look into the crystal ball of how any particular sector or the market's going to be. I think the presentation earlier was fantastic, and that was a much better synopsis of how we're looking into the future than I could possibly give as a lawyer. If I could, then I wouldn't be sitting here.
yeah, and I'll just say, Colin, just from the publications that KPMG has, I mean, healthcare is still a significant area of investment, right? So as like Austin, I'm not going to predict the future, but I would imagine, especially in this is just my personal view, it's still a very broken system, that there's still a lot of opportunity for private and public investment in healthcare for the right companies.
Yeah, it's hard to look into 26 and 27s even further out. Let's see. What's the typical acceptance rate for IPO applications?
Yeah, I'm not sure what you mean by IPO applications. There are several different review processes you have to go through legally. You have to, go through the SEC review. You have to go through FINRA review. You have to go through Nasdaq as part of the listing. But acceptances, you just keep working through the comments, and then you get to the end result of, we're through comments, and then you can go public. It's not like a situation like crypto was a couple of years ago where the SEC was really drilling down on that, and it was harder to get through SEC review. I think now you can, get back to whatever regulatory body it is with disclosure and figure out the issues and get to be public. It's just a matter of, is there a market window for you?
The real acceptance comes when you go on the market. It's not anything legal. It's you go out to try to sell your stock to investors, and do they like it or not? That's the real test. And do they like it at the price at which you're offering it, or do you need to make some adjustments?
Erica, I think this one might be for you, but what are the 1 to 2 items in the data room that healthcare investors are looking at first? Any data room, green flags or red flags?
I don't know that I could speak to healthcare directly. Maybe Austin can. I mean, I would think you always need to have audited financials, right? And then any communications from I'll just speak from the auditor's perspective. That's what I know. And any communications from your auditors, right? Over whatever time period. That's what I'd say. Austin, I don't know if you have anything, or Liz, to add to that.
Yeah, usually as part of an IPO, there's not like a data room that investors are going into. They get the S1, they're investing off of the disclosure that's in the S1 and in the roadshow. If there are certain exceptions to that, but generally speaking, it's not like they're drilling down into the information that's deeper than what's in the S1.
Some rolling right along with our questions here. What is a recommended tech stack for quality governance process?
I assume
Charlene, if you're going to elaborate on that. Recommended tech stack for a quality governance process or reporting process, etc.
I mean, from governance, you want to make sure that you've got all your information in kind of one spot. You want to make sure that you've got access to all of your policies, your committee charters, everyone, your charter and bylaws as for the organization is going to be publicly filed. But you want to make sure that all of that is in one place. Oftentimes there's, from a board perspective, you've got a Diligent and Boardvantage. There are softwares that are available that you can use that, Nasdaq has one that is pretty popular. And so there are a lot of different technologies that you can use to kind of get yourself organized. And I think that just will depend on your particular circumstances.
Let's see, moving right along. And sorry, I'm not an IPO expert like you all, so I'm just coming from what's coming from the audience. All righty.
Good.
Hopefully this one is a win. Could you please comment on the typical control deficiencies noted as part of a pre-IPO audit and typical findings? And then they're saying SD, MW, etc., and remediations. Erica, it looks like I got a good one for you.
Got a good one, and Liz may have things to add to this as well. I'll maybe take a step back and say, well, obviously, material weakness is what would need to be included in an S1, depending on timing and things like that, right? But an SD, so a significant deficiency or a deficiency, would not. I would maybe go more towards like what I typically see as control deficiencies that kind of rise to that material weakness level, excuse me, that's required to be disclosed. A lot of times, especially depending on how important or how critical the IT systems are to the company's internal control environment, we often see, material weaknesses related to the controls around that general IT environment. So that's a common area. Depending on how long the company's had their resources in place and how many years back, right, those audits have to go. A lot of times, maybe a year or two, like maybe earlier in the company's life cycle, maybe they didn't have all the right resources, maybe they didn't have all the right technical resources that they needed to kind of put the right financial statements together and disclosures and things like that. So that's something that we often see. But that's again back to, and again, a little self-serving, but getting prepared and ready early, right? If the earlier you get those advisors put in place and, an auditor that can stay with you through the process, the earlier we can help identify those things and get them fixed before it matters.
Awesome. Liz, anything to add there? Or Erica nailed it.
Leave that one for Erica.
Perfect. All right, we are almost at our key takeaway time, but there's more questions coming in. Let's see. There's one here. I guess we can't avoid a conversation in this day and age without talking about AI. So, can you please comment on the application of AI in financial reporting, since there are publications in Wall Street Journal about AI applications in financial reporting recently, including IPOs, and data leak risks as well. So I think, in short, can AI be used in the IPO filing or preparation process?
I mean, Liz touched on this earlier. If you want, you can go into, any AI application and say, draft an S1 for a company that does X, and you'll get something back. And there, I mean, I don't know, 60, 70% of it may be pretty close and usable. The problem is that you don't know what 60, 70% it is. And what really matters is the 40 to 30 to 40% that is bespoke to your company. There is a lot of, S1s are long. There's risk factors, there's a full business section, sometimes there's an industry section, there's MD&A, there's these long financial statements. And yeah, you could in theory have some sort of software that kind of takes from a bunch of different sources and pulls together a document, but that it will not be tailored to your story and your business, which is ultimately what's going to matter. You need to be thoughtful about what's going on in your business and synthesize that and put that onto paper, because it's not just about having a document to hand to investors. It's also having thought through the story. It's having thought through what the message is that I want to tell. What is going to most resonate with investors? It's not about words on a page. So yes, there are certainly opportunities to utilize AI as part of the process, and all service providers are thinking about how best to do that to best serve their clients. But ultimately, at the end of the day, it is a real-time interaction between the company and their service providers and the underwriters to make sure that the story that we're telling in the document is the right story for this company.
Yeah, to put the frosting on that cupcake, putting the document together it takes a long time, and it's challenging and annoying, and both the qualitative and the quantitative parts, you will come out of that process a better, stronger company with a better understanding of how you want to tell your story, how others look at you, and what numbers are important.
And more frosting on the cupcake, Liz. We do have a tool that will do that, right? And I think a lot of companies do as well. And so I do think using that is very beneficial, right? And something you should do. Back to what Liz and Austin are saying, you must take ownership of that. So it's a great tool and you should use it, but then it must be reviewed and then owned, right, by the management team, every single part of it. So that's what I would say. But I do think it's a great tool, and I think it's something that it can save quite a bit of time.
And I'll just
Awesome.
add to this too, from putting a candle on the cupcake, that OpenAI has actually walked away from giving legal, financial, and medical advice via ChatGPT. That is something that's been announced. So that's something to keep in mind. And to Erica Austin's and Liz's point, there are specific tools that Nasdaq has AIs built into them. AlphaSense is another company. AI is built into that. There's many tools that have already been vetted and the due diligence has done, and these are financial services companies with that vent, and they've built the technology of AI into the tools to make things easier. So I just wanted to make sure I stated.
Perfect. Well, what a wonderful conversation. So much we covered during this. But if somebody was going to dial into the last 5 minutes of this panel, what's a key takeaway? What's a golden nugget you want everyone to walk away with? Erica, maybe we'll start with you. Go to you, Austin. Liz, let's go to you. And then Roberta, I'll let you wrap it up.
Two things. Oh, sorry, Erica, go ahead.
Oh, Liz, go ahead. I would just say, and again, common theme, right, is just planning. So getting ahead of things and knowing where you're at and where you want to be. But and Austin said this earlier too. I think really a best practice is practicing, right? Practicing that you're a public company. And honestly, I think it's at least 2 to 4 quarters, because then you're going to be best in class. Again, I know that you have to balance that with the market timing, and that is outside of your control. But that's what I would say is the key takeaway for me, Colin.
Awesome. Thank you, Erica.
I'm going to answer something slightly different because Erica's right. It's prepare. It's start ahead. That's the key nugget. Know why you want to do it and know where your weaknesses are. The other thing we didn't talk about is, look, markets are volatile. And I think maybe the next panel will hit on this. Super important to prepare your employee base for the ups and downs of stocks. Just because your stock goes down doesn't mean anything is wrong with the company. Could, but it also could mean something totally extraneous to you. So helping educate all the employees when the time comes about what it means to be public and what stock market gyrations can mean will serve you well in the long run.
Awesome. Thanks, Liz. Austin?
Yeah, understand that this is an arduous process that will make you stronger on the back end, but it is just the first key step to being a public company. And so having that long-term vision across the organization is imperative.
All right, Roberta, help us land this plane. You moderated so good.
Thank you. Thank you, everyone. I mean, I'm biased, so I would say if you are thinking about it, definitely think about Nasdaq. But I had to put that plug in there. But seriously, everyone, thank you so much for this panel. Thank you, Erica, Austin, and Liz. Amazing insights that you provided to our audience. I think that everybody's going to walk away from here learning so much. Really appreciate your time and sharing your expertise. All right.
Thank you so much.
Thanks so much for having us.
Well, thank you, Roberta, for leading such a great conversation. And thank you to our expert panelists, Liz, Austin, Erica. Really appreciate the time. We are at time for a short break before our next panel. So hang tight, and we will see you back in 10 minutes for our upcoming panel. See you in a bit. Fill up your coffee cups, and we'll see you in a moment. All right, all right. Welcome back from the break. Please join me in welcoming our next panel to discuss financial reporting and investor relations. We've got Greg Henry, CFO at Password, Connor Moore, Global and America's Lead at KPMG Private Enterprise, and Alexander Porter, Senior Managing Director of New Listings and Capital Markets at Nasdaq. Welcome, team.
Thank you so much for having us.
Amazing. So excited for this. Over to you, Alex.
Excellent. Thank you, Colin. Well, good morning, good afternoon, everybody. My name is Alex Porter. I'm a senior managing director here at Nasdaq. I work with late-stage private companies, helping to bring them to market and help them through the IPO process. I've been with Nasdaq 13 years, live in the San Francisco Bay Area, and I'm also the co-president of the San Francisco Bay Area National Investor Relations Institute. So great to be here. Thanks for having us. And next off, I'll hand it over to Greg for introductions.
Yeah, thanks, Alex. Good morning, good afternoon, everybody. Thanks to Nasdaq for having me. Greg Henry, currently CFO of 1Password, been there for about 9 months, and previously spent 8 years at a company called Couchbase, which we took public in 2021 via Nasdaq.
And Connor Moore, I'm a partner with KPMG here in San Francisco, kind of specialize with working with companies pre-public and then taking them through the IPO process. And then the other hat I wear within the firm, I do run our private company practice globally. So delighted to be here, and thanks, Greg, for joining me on this.
Excellent. Well, let's jump right in. As you all know, please feel free to ask questions in the chat here, and we'll address them as we go. But let's just jump right in. And maybe Greg, we can start with you on this, but I'd love your perspective on how the IPO landscape has changed over the last 12 to 24 months, particularly around financial reporting and investor sentiment.
Yeah, look, it's obviously improved, right? I mean, we've seen a number of companies go through the process here where we had sort of a stalled period post 22 and valuations got pretty high. And so it feels like the markets are generally open, which is exciting. And I think the bar has been raised, I would say a little bit, but nonetheless, the companies that are high quality companies that can make it out of the public markets certainly have the opportunity to do that now.
Yeah, no, Alex, I would double down on that, particularly the part about the bar being lifted. Like back in, there were days back in 2021 where I thought I could probably take myself public. Like it was so frothy at that point in time. And then we've seen some fits and starts in 23 and 24, and then there would kind of be a lull again. Like for the first time, I think there probably is some cautious level of optimism. Like we're only just one sort of macroeconomic event away from it sort of going to hell in a handbasket again. But it's probably the most optimistic I've been in 18 months.
I'd love to know what kind of valuation or multiple the Connor Moore IPO would have gotten, just out of curiosity.
I'd be a buyer at any multiple.
You're very kind, Alex. I think the multiple will be a lot smaller today than in 2021.
Well, it's a good segue. Like, what are you seeing in terms of investors prioritizing in terms of characteristics? Is it revenue quality? Is it profitability? Is it predictability of revenue? What are you guys seeing in the market? Connor, maybe to you first.
Yeah, I think the market's become more selective. Like joking aside from 2021, we had models back there where you pay $1.50 in OpEx and you get $1 revenue, and people were getting excited about those companies. I mean, I think everybody's got a lot smarter now, and it's not just revenue growth. Like revenue growth needs to be meaningful, but there needs to be at least profitability or a fairly short-term path to profitability. I think also there needs to be sort of a better articulation of the competitive landscape. Like why is what you're doing different to what somebody else is doing? And bear in mind, I don't know what the latest number is, but I think at some point in time in early 2025, there was like 200 companies who had essentially been approved by the SEC to go public, and they're all pent up, ready to go. And there's a lot of high quality companies in that cohort of companies ready to go. So like if you're going to go in the next 12 to 18 months, you're going to have some pretty stiff competition for attention. So I think those things have changed over the last 18 months.
Yeah, and Greg, as an operator, kind of what What internal signals, give you the confidence to start getting on the IPO readiness track?
Yeah, I think it goes back to what Connor was saying. To me, there's two things. There's the financial metrics, right? Are you going to attract the right kind of buyers in terms of your scale, growth, profitability, and other KPIs around net retention rate and customer growth and all those things that I think everybody knows about. And then there's just to me, there's just this, and probably didn't know this as much the first time. I know a little bit better now. There's just a general feeling like, is the business ready? Do we have processes, people, controls, predictability? Like, is the leadership in place? Is the N-1 to the leadership the right people? Like, because you don't want to be going out and trying to sort of swap all this stuff after you go out. So there's a quantitative piece that's really important, but the qualitative piece of having the right, again, pieces, parts together to go out. Because look, we'll get into this, but like we went public in 21. We probably wouldn't have gone public in currently at Couchbase, and we kind of muddled around, and I just don't think anybody wants to get into that. So having all that sort of bundled together gives you the right sort of feeling that it's the time to go.
Yeah, for sure. It's a lot to manage: people, process, controls, leadership, predictability. When you think about the reporting processes specifically, like, what's the top priority when you're 18 to 12 months out from a potential IPO?
Yeah, again, to me, it's about can you close the books timely?
Yeah.
I think timely, like I've been fortunate both at the last place and currently, we kind of close the books in about 5 days to get to the point where you can actually then report and do your analysis. I think it's, again, having controls around the process where you're not having to make a bunch of late entries. What you see even on day one is the same thing you generally see on day 5, day 8, whatever it is. So you have that. And then, again, the predictability piece. So the one thing that I did wrong the first time, which I'm not going to repeat, is you hear about this whole beat and raise process. And what we were doing is previously was running the beat part, but not the raise. And it's just as important, because you can beat on all your metrics, but if you can't raise, and can you raise by the full amount of the beat and all these sort of nuanced pieces, that's going to be critical, right? And do you have that rhythm?
And I think, Alex, I'd add to that, like when boards and audit committee ask me that same question, I do tend to focus on, like, can you close the books timely, and I'm sure Greg intended this word too, but timely and accurately. I mean, I have sat in meetings where people are like, oh yeah, we close the books in 5 days. And apart from these two accounts, which take like another 45 days, like it has to be accurate. So if you're seeing like in a subsequent quarter, you're seeing like adjustments to the prior quarter, like I think it's a pretty clear sign that you're not ready. So that accuracy thing is pretty important. Because as a public company, there's just a lot you got to pack in those 40 or 45 days to be successful.
Yeah. And I'm sure you get better and better at this process, right? Once you start practicing and providing that kind of internal guidance. How many quarters do you think it should take to really get it close to perfect?
It'll vary, Alex, from like folks who've been there, done this before. But I think if you're a first-time CEO and you're a first-time CFO and you're going through this process, like I'd probably be advocating that you do it 2 or 3 times. Now maybe the first time you do it, you don't necessarily do the mock earnings release and get people in a room to fire questions at you and things like that. Maybe you wait for quarter 2 or quarter 3. That's generally what I counsel people. Could you do it in one? I think you could if you had people who'd been there, done that before. But 2 or 3, I think boards and other stakeholders probably feel more comfortable with that.
Yeah, I would have probably taken out even longer. Like I'd want to make sure I had at least a year, so call it 4 quarters of closing the books timely, accurately, as you pointed out, reporting and running on a public company cadence. Which, if you think about it, like you got to have, depending on when you want to do earnings, but it's typically like the 5th week after the close, right? So like just into the following month. And so can you get to where you can have close the books, report, have your internal QBR, quarterly business reviews, be prepared for the board and audit committee, all the things and then still do, you don't have to do it like Connor said, but still be ready to have a script, your Q&A, like all that stuff sort of bundled together in that time frame. So like when I walked into 1Password, which we had a good rhythm, but we were still doing board meetings in a private company cadence, which was more like, call it six. We did the board meeting 6 weeks after the close versus more like 3 or 4. And so just having to pull that in and condense all that's a whole new muscle.
Yeah, just to segue into broader IPO readiness, there's folks on this call who are at a lot of different stages of their growth cycle, and we oftentimes get the question, Connor, like, what does IPO readiness actually entail? So maybe you can give an overview of what readiness, what kind of is encompassed in IPO readiness, and then what are some of the key areas of focus? Where do you see like the most common deficiencies? What typically takes the longest? Maybe just frame that out for our audience.
Yes, I think like just to focus maybe narrowly first on financial reporting. So there's the need for PCAOB audits for, I mean, most companies on the phone would probably qualify as emerging growth companies. So you're going to need that for 2 years. And many people on the call are probably familiar with the difference, but there's a meaningful difference between an AICPA audit and a PCAOB audit, and those that have gone through both can probably appreciate that. So make sure you're aligned with your audit firm. And I'm not going to sit here and say KPMG has never done this, but like get with your audit partner and say, okay, what type of audit have you done? Because like people will say, yeah, we did a PCAOB audit, but maybe we didn't do these 4 or 5 things. Those 4 or 5 things might take a month. They might take 2 months. So you really need to develop that direct conversation, that trust with your audit partner to make sure what it is that you actually got left to do. We probably touch on team later on, and Greg can probably speak to this given that he's built out a team. I think you then need to focus on the team. Greg would probably agree with this, but I've heard CFOs, legal counsel, CAOs, et cetera, say that for the IPO period, you for 6 to 12 months, you've got 2 jobs, right? You got the IPO process, and then you've got the day job. And the last thing you want to do is over focus on the IPO job, and then the day job doesn't get done. You've got material weaknesses, and you miss the numbers, and all this sort of stuff. And then probably the last thing is the systems piece. Do I have the right systems in place? And even if I know that I don't, can I time fixing that in a way that's not going to jeopardize timeline? Because you don't want to be changing your ERP system and having a bunch of auditors running around at the same time. So kind of mapping that out is important. And then to your point about deficiencies, it's almost the reverse of those things. So you have audits done, and there's a bunch of audit misstatements that your auditor comes up with, or even things that the company finds related to prior periods. Then you have material weaknesses. Now, I will say material weaknesses they're not death knells for the IPO, but obviously you would sooner avoid them. I think there's statistics that somewhere between 25 and 35% of S1s actually have material weaknesses in there. So it's not going to prevent you going out. But you really need to have a clear plan as to how you fix it. And I think audit committee chairs get very, very focused on that because they're obviously taking some of that risk. So I think it's systems, and then also people. Like, do you really have the people in place? And you'll see a lot of these material weaknesses actually call out not having sufficient qualified finance resources. So that's just to give a broad picture of at least what I look at when it comes to readiness and where people might fall down.
The other one I would just tag on, and I totally agree with everything you said, Connor, is getting aligned on what your public company key metrics would be early on, and making sure that how they're defined is aligned with management, the board, and that you have enough history of those. I had an experience when I went through the IPO where our understanding of what one of our non-GAAP metrics was not what the board had wanted, and it required us to go change things and do a bunch of like recreating financials historically on non-GAAP. And so just get alignment on what those key metrics are going to be, and do more than you might need, but just know that you're going to be able to at least get whatever your 2, 3, 4 out of those ones that you're measuring.
Yeah, 100%, Greg. And I think one kind of misconception with these non-GAAP metrics is that the 4 or 5 metrics you might have at the front of the document, like the only one that's probably sitting in your financial statements might be your revenue number. And these other metrics, depending how your organization works, they don't get the same level of rigor that the GAAP numbers do, because maybe they're work done by people that aren't in your core accounting group. They don't get audited. So the audit firm is not opining on those metrics. I've definitely had CFOs, to your point, Greg, who place as much, if not more, scrutiny on the accuracy of those non-GAAP numbers. Because they'll do an earnings release and the GAAP numbers may be perfect, but if the non-GAAP ones aren't, that's not going to be a good earnings release. So completely agree.
Yeah, and one of the things that we've seen change in the IPO market over the last couple of years is just need for a longer runway and more interaction with institutional investors ahead of the IPO. What 6 months used to be sufficient for Tesla Waters and Roadshow, now we see companies engaging 2 years before an IPO with institutional investors, and you want to make sure those KPIs stay consistent. So build the KPIs, build consensus around the KPIs early is really great guidance. And Connor, maybe just piggybacking on your comments around the leadership team, Greg, I'd love your take on kind of what it takes to build out a high quality leadership team from a finance perspective, and kind of what you look for and how you think through that process.
Yeah, well, obviously, in the finance leader's position, I think the two key ones are clearly your FP&A lead and your accounting lead, your controller, chief accounting officer. So you obviously would prefer to have somebody who's sort of been there, done that. It certainly helps, especially, and when I say been there, done that, I don't mean you have to have gone through an IPO, but have worked in a public company environment so you understand sort of the on the controller side, like the SEC reporting and equity and all the other, piece parts, SOX, internal controls, just understanding it, even if you haven't gone through it. And then the FP&A side is, do you have somebody who, can be your right-hand person, strategically looking at things, looking ahead, helping on the beat and raise, right? Thinking not just this quarter or next, but further out. So to me, those are the two really key people that you want to have. And when you come into a role, if you don't have the people that you're willing to go through that battle with today, unfortunately, you probably don't want to wait, because otherwise you're going to get to the point, and then all of a sudden it's like, all right, let's go, and then, oh my gosh, I got to bring in somebody new. I don't have the right person. Well, they don't have the history, they don't understand the business, so you really want those people to be in chair for a year or two before you go through the process.
And I think Alex said, I'd add to completely agree. Those are the critical positions. But also take a look at the broader C-level team, like IPOs that can go a little bit sideways is when the company has a view that this is entirely Greg's problem, or maybe Greg and the in-house counsel. It's not a company-wide effort. And those ones can be tricky because everybody else is kind of behaving like a private company, and finance and legal are trying to drum people into shape. And I've worked with a lot of stellar finance individuals over the years, but I've yet to find one who can actually account for something that they weren't aware of. And that's where I think having some level of experience in a public company environment among the broader C-level team is important.
No doubt. Switching gears a little bit to the storytelling piece from an investor perspective, Connor, what do you think makes a compelling equity story to institutional investors today?
We touched a little bit on it earlier on. So meaningful revenue growth, profitability, but in these days, even a stronger ability to articulate why you're different, why you can go after this market. So first laying out what the total addressable market is, but why you're the one that's going to achieve X% of that market, because there's more. I think there are more headwinds these days, particularly when it comes to technology plays, where the answer on the other side of the table is, well, can't AI do that? And I realize many people on the phone, there may have been a collective eye roll when I said that, but like it's a thing, right? When you've got CEOs out there saying, well, like we're not going to hire anybody unless somebody explains to me why AI can't do that role. I think there's a lot more pressure on business models to say, okay, how are you going to actually stand the test of time over the next arguably 2 or 3 years, where we may see a greater shift in technology than we've ever seen over a 2 or 3 year period in the past. So those would be the things that I would point out. Maybe the other thing is just underscoring the quality of the management team and the board, et cetera. It just gives an extra level of confidence that one's going to be able to execute.
And then Greg, is in relation to actually telling that story, you've done thousands of investor meetings, so you're incredibly experienced in this area. But what guidance would you give to maybe first-time CFOs bringing their company public as to like how to really prepare for investor meetings, how to prepare for kind of those mid to later stage investor engagements?
Practice. Just practice. No, I mean, serious. It's just go to some of the conferences, meet with, and make sure you have somebody sort of helping you to make sure that you're meeting with the right people. You're getting a good variety of different investors, right? So you're not all just hedge funds or not all long onlys. You're dealing with people that have large assets under management, some small, because you're going to get all the above. And so just understanding what they're thinking about, how they're thinking about things. And then practice a story. And again, I think someone alluded, you might have Alex alluded to it, is like be thoughtful of like what you're telling them today, of where you're at and where you think you can go, because you'll probably meet them again in a year or two, and they're meticulous at taking notes and following back, and they will tell you that the majority of people do not ultimately deliver on what they say they're going to do, because it's easier to do that outside of public company world, and that's where some of that practice of like thinking about beat and raise and like what am I going to really commit to, because they'll start making a judgment of like, can I trust this finance leader, because are they telling me a story I can believe in that they can go deliver, because that's what I'm going to be betting on in the public markets.
And maybe kind of circling back to even the finance leadership build out question, there's a couple different approaches companies can take from an IR standpoint. Do you outsource IR to one of the big IR firms? Do you insource IR and bring on a investor relations officer? Greg, how have you thought about that calculation in the past?
Yeah. So previously, when I was at Couchbase, we hired one of the firms even pre-IPO, probably 6 to 12 months before, and they became our whole IR arm to and through the IPO, and we never actually hired an IR leader. Now, the reality is we were a small cap, and so it was sort of manageable. We had 12 or 13 banks following us, so it wasn't, you're not mid or large cap with 30 or 40 banks following you. I walked into one password. We had already been using not only an external firm, but had hired somebody internally. So we're probably a little bit ahead of where we need to be. But it's incredibly helpful, because when I go to these conferences, I have people looking, like, hey, have we met these people before? Are they customers? If we met them before, when was it? Who did we meet? Just all the little things that when you walk into these meetings, you can be like, hey, Connor, good to meet you again. It was great to see you last year at Morgan Stanley. Glad it just builds the relationship, and they appreciate that you're not just there sort of shaking hands, that you're, building relationships. But you could do either. You could do in-house or external. It both works. I think it's a personal preference, and again, it depends on size and scale and complexity of the business.
Yeah, I agree. And we talked about the consistency of metrics being important, just building trust with the investors being important. Greg, like, what do you wish you had known about engaging with investors, above and beyond what you've already commented on as you've gone through this process?
Yeah, like that's why I was talking about the key metrics. So one of the things we I did at Couchbase was we put in customer count as a key metric, and we were it was a database software company that did sort of larger deployments. So the ARR per customer was like 250,000. So we had big scaled customers, but we had very few, and the investors would just get so focused on our customer count versus our ARR growth. And so I probably would have thought about that one a little differently, because whether we had a 10 or 20 customers in a quarter, the new logos weren't driving it. It was all the existing customers. So just that little nuance. And again, I go back to just be consistent through the whole process. Um, you want to ultimately get known. People used to be like, "Oh, you're conservative, you're a steady pair of hands," but ultimately that's what they want, even though it sounds sort of maybe negative. Like, but just be consistent and maniacal, and build the trust that you're the person who can, steer the company, and they can trust that it's going to, be a nice glide path in the public markets.
Connor, you've helped thousands of companies, and maybe not thousands, but certainly maybe hundreds. KPMG certainly has done thousands. But like, what is your perspective on this? Like, what do, in your experience, CFOs, CEOs, founders wish they had known about kind of the investor engagement, KPI development, financial reporting process going through this the first time?
I think when I think back on maybe where things didn't go as well, and Greg touched on it, it's maybe CEO, CFO, and others that are part of the investor relations pitch not necessarily being consistent, and not picking on CEOs, but oftentimes the CEO could be the outlier, because I mean they're, particularly if they're founder CEOs, right? This is their baby, this is their passion. One IPO in particular that got delayed almost by 2 months, because at some point in time the CEO got a copy of the S1 that the working group felt was pretty close to final, and he had not been part of the process, and he reviewed it, and he's like, look, this is nothing close to the company that I founded. So it basically was a complete rewrite. So now that it's rare that the CEO is that distant from the process, and I think others should have probably brought him into the fold earlier. So I think it's really that, just making sure that everybody involved is singing from the same hymn book. Those are the ones that tend to go better than the opposite.
And as you get really close to that final mile during the IPO process, what KPIs do you think the investors really tend to focus on?
Well, Greg has probably seen more of that than I have, but I know when we're always part of due diligence calls. Like, it seems like they happen every 2 or 3 days when you get down to the final strokes, and there's a lot of questioning around, okay, what's happened recently? So like, what's happened in the last quarter? What's happened in the last month? Anything new? Anything negative? So it goes to a very heavy focus on a much shorter period of time during that roadshow process.
Yeah, and I just say it's all the sort of non-headline metrics. So it's not the ARR or the growth rate. It's gross retention, net retention, ARR per customer, things like that. That's going to give them the sort of sense, like, is this business sticky? Did they just get lucky through a certain economic period? But is this going to be a sustainable growth story into the public markets when things maybe aren't quite as good as they have been recently?
And I understand we have quite a number of CEO founders on the call today. In both of your experiences, like, what can a founder start doing tomorrow if they plan to take their company public in 12 to 18 months?
Talk to other founders who've done it. Like, literally, that's probably the single piece of, I mean, Greg mentioned earlier, the sort of the practice concept is important as well, but talk and listen to those who've done it before. Like, I've had CFOs, and Greg, maybe you felt this way at Couchbase, who prior to taking a company public, they're coming to me and saying, can you connect me with folks who've done this before? And then they said, magically, kind of 24 hours after the IPO happened, they're all getting inbound phone calls because they're now the expert. So I think really surrounding yourself with people who've done it before, and of course being willing to listen to what it is they say.
Yeah, I tell a CEO, make sure you have a CFO that you feel comfortable with. That, again, just like I was saying about hiring FP&A and controller, this is the person you can see to and through the IPO. Because again, you don't want to be changing somebody out after going through the public. So, and you really want to have, like, look, the CEO CFO relationship is a marriage of sorts. So you want to make sure that you have sort of just general fiscal. Think about a marriage. You want to be fiscally aligned. You want to be aligned with how you think about the company in terms of what you want to say, what you don't want to say. Connor's point's great. I was going to bring that up too. Everybody, whether a CEO, CFO, you got to have a network. And then you ultimately, within the network, you want to have a couple people that can be trusted advisors when, things get real. The reality is if you get a good bank, which you will, a good law firm, which you will, a good auditor, a good IR person or firm, like, ultimately the guardrails come up so that you're not going to hit a gutter ball, but are you going to hit a strike? I don't know. That's the piece that you got to work on to make sure it stays down the middle of the lane.
Actually, love that analogy. Yeah, the ecosystem's certainly there to help and support you. But yeah, building out a network is something we recommend to founders and CFOs going through this for the first time as early as you possibly can. And then just more broadly, Greg, maybe I'll start with you on this one as we wrap up before we go to Q&A. But what do you wish you had known? Like, what are the couple things that just taking yourself back, like what are the most important things you wish you had known now having been in the seat and the experience that you have today?
Yeah, for me personally, the one thing I always talk about that was a huge learning, and I had a good network and would hear from other CFOs that took company public. There's a lot of things talked about. The one thing that I never heard, which I experienced, was ultimately it really will fall on the CFO to sort of build the syndicate and work with the banks to build that. And there's only so much economics to go around, so you can only have a finite number of bankers. Everybody's been courting you and dating you and has expectations to be part of it, and you're going to eventually have to tell people no, or you're not going to be able to get to that right economic point where they're willing to take whatever you're giving them at the right, which line they're on and how far left on the line they are, because it's all about that. And so that was a really interesting process. And the reality is once you tell a bank that they're not going to be part of your IPO, again, it's like breaking up with your girlfriend. Like you're not going to hear for her for a long time, maybe in a few years. But just so when you're going through the private company thing and everybody's again inviting you to their conferences and want to do this and that with you, you just know at some point you're not going to be able to satisfy everybody. And so just prepare yourself for that. And again, any help you can get about thinking, and this is where the IR and the banks will help you a little bit, is about how to structure that syndicate to, again, do what's going to be best for the company.
Super helpful. Connor, any other guidance too, and just in terms of, having taken so many companies public, like what are the things that you think companies should know?
I'd probably go to resourcing. And Greg talked about how to build out a team, all of which makes sense. But you've also got to make certain decisions around, okay, do I hire somebody to do this work as a full-time employee? Do I get consultants on board? What's going to happen post-public? Like I think generally people underestimate the effort that's involved. And as a private company, you can get away with things like, oh, well, we kind of missed the deadline for issuing our financial statements because so-and-so was sick or was on parental leave or this happened. Like none of those excuses fly in a public company environment. So resourcing yourself appropriately, whether it's internal or external, and having a little bit of a redundancy within your group so that if God forbid your CAO ups and leaves at some point in time or something happens to them, that you're not starting from scratch. Building redundancy within your team is important. But I think maybe the biggest thing I've seen is people just underestimating the effort that's involved in this entire process.
Yeah, and Alex, if I can just add one more as you go through this, even though Connor mentioned that most companies won't have to be SOX 404(b) compliant right out of the gate. You do want to put a lens to that because it may come up quickly. And some of the areas, particularly I've seen around HR processes and obviously IT general controls is the biggest one. Again, anything you can do to just get ahead of that, whether it's pre-IPO or just after, but those things can be pretty big hurdles in the public markets to get through.
Yeah, and it's a great point because for people on the phone, yes, your 404(b) SOX opinion, you might get a year's hiatus from having to do that. But like in One Password's case, Greg and his CEO are going to have to be signing certifications right out of the gate that things are working well. So that does focus the mind around making sure you've kind of got a plan that they're all fixed.
Awesome. Great guidance, guys. We're getting some good questions through the webinar chat and the Q&A box. Please, everybody, feel free to add more. But there was a question on sales and revenue, and I'd love both of your takes on this. But are there any changes that you make to your go-to-market strategy that have been really successful, that you've seen been really successful in the past? Is there any key leadership hires on the revenue side or the sales team size that you think about as you get closer to an IPO, maybe 12 to 18 months out? Like what changes do you make commercially from a sales perspective?
Yeah, for me, it's actually maybe even more on the marketing side. It's about the pipeline building and can you continue to build the pipeline and the funnel that you're going to need multiple quarters out to build that predictability. So it's even sort of more on the tip of the spear than just the sales organization. And then again, the one for me on sales is just like looking at how much revenue or ARR per salesperson you're getting and how does it benchmark and what's the trajectory of that? Like, are they getting more efficient, less efficient? all those things. Those are the big ones I would look at.
I think, Alex, another thing that evolves over time is that the kind of scrappy startup of the world who's growing and growing, they kind of, in almost every revenue deal, they kind of got to accept the terms and conditions and the paper of the other side. I think as you mature and you kind of have a little bit more leverage in these situations, a lot of revenue contracts, the goal would be to try and make them as similar as possible. It just mitigates the chances of something going wrong. So I think instilling that discipline and without turning off the faucet, but just having a little bit of discipline within the sales forecast or the sales team. That's like, well, do we have to give them that condition? Can we kind of push back and still close the deal? Building that muscle, I think, is helpful within the sales organization.
Yeah, you don't want to be like riding the rails heading into the IPO, meaning if you're like being super aggressive on the sales front with either contract terms or legal terms, or you've drained pipeline, like it'll feel good to get you to the IPO, but then you're going to struggle, and it's just not a fun place to be.
Investors want to see consistency. Another great question coming out about kind of the IPO, the alternatives to a traditional IPO that we've seen over the last couple decades. SPACs being one alternative to a traditional IPO, direct listings being another alternative to the IPO. I know Liz Beyer was on the last panel. She has a lot of experience helping companies with direct listings. I mean, our Nasdaq's take on this is the IPOs are by far still the most popular method of going public. They inspire the most investor confidence. You get the full leverage of the banks, sales organizations to help sell the story to the institutional community globally. The direct listings, they're really a bull market product, and the company needs to be of a certain scale and a certain size to really have the investor visibility that it requires to generate enough demand. And we saw a lot of SPACs in 2020, 2021. They were very popular. They are kind of coming back to the market. We're seeing a lot of new back issuances coming. But they do have a certain investor perception because most of the companies that were taken public through SPAC in 2021 are now trading far below their listing price. So you do have to balance some of the pros and cons. But Greg and Connor, I'd love your take on the various options for actually going public.
I'd agree with everything you said, but ultimately you got to do the best thing for the company, right? And so if you have an amazing consumer brand and you meet all the aspects that a direct listing would require, that may be, and maybe you don't want to do much primary capital raise, that might be better. But I think you got to do what's best for the company. The reality is to me, most employees want to have a traditional IPO and make it a big marketing event for them, make it a big marketing event for your sales team. So I'm a bit of a fan of the traditional IPO.
Yeah, and I remember back I actually did Slack's IPO, and I think Slack might have been the first direct listing that was actually in the US. And I think there was an expectation that would have been back, I think 2019, there was an expectation that there would be a lot more than there actually has been. So to Greg's point, if you fit the profile, maybe it's a way to go. But just obviously seeing way more of the traditional stuff. The SPAC stuff, you're right, Alex. It is coming back to a certain extent, but there's just a lot more sanity in the process now. I mean, the people who would talk to me back in 21 and say, "Well, Connor, it's much easier to be a public company if you do it through a SPAC." To which the obvious answer is, well, no, you're still a public company. It's exactly the same as if you went through the regular route. And then I think the other thing that people have learned is when the SPAC thing happens, you get a couple of people on your board, like those people are thrusted on you in terms of getting on your board. It's not like you've gone out and picked them like you would in a regular IPO. And I think that's kind of bitten some people over the last couple of years as well. So I wouldn't say SPACs are gone and that we won't see an increase in them. I just think there'll be a little bit more sanity in the process, hopefully.
Yeah, and Alex, maybe just one more thing. We didn't talk about this for CEOs and CFOs. Make sure you have the board you want for the public company, because like Connor was saying, is you want the people who have the experience, who are going to be supportive. You get a good balance of somebody who's done commercial versus technical. Obviously, you need an audit chair, those types of things. I think it's always awesome for particularly if you're a founder, to have somebody who's been a CEO on your board who can be your, your person you go to. So board composition is incredibly important.
Great point. Great point. Yeah, we oftentimes see companies, kind of waiting to hire independent directors until the last minute, and you don't want to forget that those people are going to be your boss. So bring them in early, and be really thoughtful about governance and your board for sure. Another question came in around, the benefits of um, having a company that has kind of a positive impact, a positive societal impact, B Corps, for instance, or companies that are really strong in ESG. We've seen, the perception of the market kind of change over time, in part driven by political, which way the political winds are flowing. But Connor, would love your perspective here on how that kind of changes the process for companies, or kind of what the investor sentiment might be.
I guess without it getting too much into the politics of it, I mean, I think it's safe to say if you went back 2 or 3 years ago, you would probably have said that there would be a lot more dollars sort of flowing into ESG initiatives than there are necessarily today, and some of that, to your point, has been political. What I would say though is that as the younger generation, and I have a couple of kids in that generation, I can kind of see their behavior as they continue to have a greater influence on the market, and they've got a greater share of disposable income. This stuff is going to be more important. Not to suggest that people like Greg and I don't care or are cynical about it. I just think companies.
You call me old, Connor. You call me old. I'm not old. I'm young. I care.
I just think it's going to become more important. I don't know necessarily today how much value it necessarily buys you, but I do think it'll change over time.
The reality is the majority of the investors are looking to, let's be honest, make money. And so, yes, there's some funds that clearly have requirements that may not be investors, but the predominant focus is on high quality companies today. But I agree with Connor that it's going to become more and more important.
Completely agree. Are there any more questions from the audience? Maybe we'll just give it a beat here to take any more questions. All right, great. Well, this was a great panel. Thank you all for your time, for your attention. Greg and Connor, it was great. Connor, actually, as a quick wrap up, when you take the Connor Moore company public, are you going to do a traditional IPO, a direct listing? What's your vehicle going to be?
Well, hopefully it's not a surprise to you, but I'm not quite of the scale that Greg referred to. One would need to. So at this stage, I'll probably take any SPAC that's out there to do one.
That's great. Excellent. Well, thank you, everybody. Back to you.
Awesome. Well, thank you, Alex. Thank you, Greg. Thank you, Connor. We have a couple of pre-submitted questions that I'd love to get to if possible. So let's see. There are a lot of details when it comes to the roadshow and obviously that the big day. So any advice around just the day of, Greg, Connor?
I mean, the day of is it's the fun part, right? I mean, for anybody who's gone through getting married, it's your wedding day, right? And so there's a bit of a party. I mean, yes, you might have to do some media and things like that. It's really all the leading up to, and then coming back from the wedding and realizing, okay, we're married now. We got to start living together and doing all the things. So the day of is great. The roadshow, it definitely can be a grind. Like, think about doing the same presentation 6 times a day for 6 or 7 days straight. And quite honestly, it really will fall. I'd say 75% of it's going to fall on the CEO, only about 25% on the CFO. So it's a long haul to get through all those meetings and present the same thing over and over and over.
Yeah, I'd agree, Colin. And actually, the marriage analogy is a very, very good one. It's an awesome day, but the honeymoon period is very, very short when you get back to the office.
Yeah. My guidance
Yeah,
would be
I would
have
definitely,
fun, enjoy it.
yeah, and I definitely, if you can, so I would not necessarily recommend, and we did this, but going public in the third month of your quarter, meaning you're going to get back from your IPO and then you're going to get right into quarter end and your first earnings. Like you want to, there's no honeymoon, right? There's nothing. So yeah, think about that.
So let's see. There's another question here. You talked a little bit about the de-SPAC stuff, and some of the trends there, but somebody said, what about reverse mergers? Connor?
I mean, a lot of times when we see reverse mergers, a lot of times it may be an overseas entity that's merging into sort of a pre-existing registered company, and not to impugn that entire population, but it's definitely a little bit different. There's a little bit more skepticism to it as opposed to a situation where you've got underwriters and a working group and all those people that Greg had mentioned earlier on. So again, there may be facts and circumstances that it suits certain companies, but obviously we work with a much smaller number of those than we do with traditional IPOs or direct listings.
That covers it. Okay, let's see. There's some other questions here. Alex, I'm gonna ask you for your advice because you have a decent amount of experience in this one. So what advice do you have for founders about staying consistent with messaging from the roadshow to post-IPO quarterly calls?
So how do you maintain consistency after the IPO itself, after you start operating
Yeah,
as
like during the
a public
roadshow
company?
and then post, yeah.
Well, I think Greg touched on this earlier, right? It's like investors want to hear the story that you told them during the roadshow process. And I think you buy yourself a lot of credibility by um, executing on the guidance that you're giving and making sure that you're following through on the story you've laid out. It's incredibly important that again, you want to be able to forecast beat and raise type situations 12 to 18 months before the IPO. And you really want to be thoughtful about those couple quarters after the IPO to make sure that you can stay consistent in that beat and raise. So I think it starts all the way back before the IPO, 18 months, and building that muscle memory and predictability in your business. That's going to be so important as a public company. That's when it really starts to matter.
Awesome. We're getting nods across the board. We're going to talk a little bit more about governance in our next panel, but any advice on like prepping for board governance early on? Greg, I'm sure you've seen this, or for like employee, just overall general employee readiness too.
Yeah, so I talked about the board piece. I do think
Yeah.
it's, once you make the decision to go and it's sort of public, and by the way, there's a high probability that it'll leak before you even file, quite honestly, just because, if you're talking with bankers and things, it just leaks. So you do want to, you ultimately want to prepare your company and the employees. The one thing I would tell you is that I always focus on is I was never focused on the IPO. I was focused on being a great public company. And again, using the marriage analogy, which is like the IPO is the day and then it's everything after. So if you get the mindset about being a public company, it's just a better one, right? And it's so everyone's not hung up about the day. It's like more about the journey. The one thing I did experience, so sorry, Kyle. The one thing is a lot of companies will have to go through reverse stock split to get the price to where you want it in the markets. And I just know, having gone through that, we really struggled with some of the employees understanding that, well, wait a second, I have, the stock price is up, but they were all focused on having less shares. And so there's just massive education that you have to do. Like, hey, would you rather have a $1 bill, 4 quarters, 20 nickels, 10 dimes? Like, it's all the same, but like just helping them understand, because what they see is I had 10,000 shares and now I have 5,000. Like, what happened? Like, I lost. And so there is some of this nuanced education as you go through the process.
Yeah, and further to that too, going from a private company to a public company is a massive shift. And culturally, it can be a big shift for a lot of companies too. A lot of private companies post their monthly revenue on every town hall, right? That's going to have to stop. expectations are going to have to be changed from an employee perspective. And after the IPO, the reality is that every one of those employees is going to be glued to whatever brokerage app they're using to track the stock and to track their new net worth. And hiring, I think, a really strong communications leader and training the executives on how to communicate and set expectations early on as to what it means to be a public company, what spikes and drops in the stock actually reflect. Again, not necessarily being the health of the company on a daily basis, but educating the employee base is an incredibly important part of employee retention after the IPO.
Yeah, I agree with all those comments, Colin. I think the law firms in particular do a good job of sort of running education sessions for employees, and I probably encourage people to do that as early in the process as they can.
But
Awesome.
even, you have to even think about it now, because like I get this thing like, oh, I want access to our ARR data, and I'm like, well, you realize like that is material non-public information. So if you're going to get access to it to try to do something, whatever it is, just understand that in a public company setting, you're going to go on the proverbial blacklist, and you're going to have to request every time you want to trade because you have material non-public information. And so people don't understand that, right? They just was like, well, I'm trying to do my job, and it's like, I understand, but unless this is absolutely critical, you don't want to put yourself in that position.
Awesome advice. The first panel talked about AI, and so did you. So I'm going to pivot on this one. We got a bunch of pre-submitted questions asking around predictions around bio and life sciences in 2026. Any optimism, any predictions for that opening up more next year?
I don't, Colin, to be honest. I'm sort of fairly 100% double down on tech. But I mean, I think there is some logic, again, going back to the sort of the competition for investors, et cetera. Like, I think as long as the tech, I don't want to use the word bubble, but as long as the tech sort of momentum continues, it may continue to be difficult for those companies to get the requisite attention. Now I think there's a little bit of a difference between bio and health tech. Like health tech, on the other hand, I'd be a little bit more optimistic about that. I think there's a lot of stuff coming out of that particular space which could garner more interest in 26.
Yeah, and I'd add on just in particular to biotech, it's a highly volatile market. It's kind of it can be very volatile for companies, and it's a high risk investment for a lot of institutional investors. And so I think you're going to need to start to see interest rates come down, more assets moving towards risk assets like biotech, like equities. The biotech market's actually performed very well this year, but it's been under pressure for the last 3 or 4. So I think if you continue to see the Nasdaq Biotech Index continue to do well, I think if you start to see rates come down, more assets will flow to risk assets. And you could see that market do very well in the future.
Awesome. We're getting nods from Greg.
Well, I get it, but I'm also in the tech side, so I don't
Yeah.
want to. I can't
No,
really.
yeah.
I just go back to all high quality companies can go public, right? I mean, that's what it comes down to.
Great companies. Well, with all that said, so many great insights shared. I'd love to wrap up this panel with just one golden nugget of piece of advice, insights for our attendees today on this panel. So maybe I'll go backwards. Greg, I'll start with you, Alexander, Alex, and Connor. Great.
Yeah, look, again, all good companies can have, if you're a great company, you can go public. I don't, and it's easy for me to say because I've having done it once, but I don't focus on an IPO or I focus on being public company ready, and I really would rather focus on building the company and running the company than just getting caught up in the IPO. And when people sometimes will come up and be like, "Hey, when do you think we're going to go public?" I kind of turn around and be like, "Well, what are you trying to get out of it? Is it recognition, money, like what is it?" Because it's different to everybody. And so I try to keep, again, myself and everybody else focused on the business. And if you do that, I think all good things will come.
Thanks, Greg. Alex?
I'm just going to double down on what Greg and Connor said earlier about the importance of your network and finding a mentor who's been through this process before. I think everybody on the call is doing the right thing by learning and attending panels like this. But the most important thing is going to be, finding somebody you trust to ask those tough questions and to help understand the experience from somebody who's really lived it one-on-one. So if there's anything you take away from this, reach out to somebody new today to, build the relationship and to continue learning.
Amazing, Alex.
And I guess, Colin, not to end it on any type of contrarian note, because I know it's an IPO boot camp, but I think, one of the questions a lot of people need to ask themselves is like, do they want to be a public company, right? Like there's plenty of private capital available, and I think we all know of some fairly big names that continue to stay private and they provide liquidity for their employees, et cetera. And yes, like the venture investors are typically going to want the IPO to give you the 10x to 20x return. But just ask yourself, do you want to be that person? And if you don't, there's absolutely nothing wrong with that. But I think once you make the decision to go, you need everybody that's in the bus with you committed and wanting to be part of a public company. So that's maybe just a slightly different take on a question that people should ask themselves before they head down this path, because it ain't easy. And as Greg knows, it ain't easy on the other side either.
Awesome. Well, that's great advice. And that's why this boot camp exists, Connor, for exit optionality education, my friend. Well, thank you all for joining us today, sharing some insights. Greg, thanks for sharing some of your first world insights. Connor, of course, always great to see you. Thank you so much. And Alex, thanks for leading such a great discussion. And of course, for adding some of your personal experience there too.
Thanks all. Appreciate
Thanks,
it.
everybody.
Take care.
Amazing. All righty. Well, for those still on, we are going to take a quick break. So fill up your coffee cup, but we will be back in 10 with a post-IPO growth and compliance panel. So thank you so much, and we will be right back. All right, all right. Welcome back from the break. And we've got one more panel for you in this boot camp. Please join me in welcoming our next panel of experts to discuss post-IPO growth and compliance. Up first, we have Dan Mochizuki, who's a director at KPMG. We have Andy Gilman, partner at Wilson Sonsini, and we have Bobby Bartlett, professor of law at business at Stanford Law School. Welcome, team. And I think I got to, oh, just waiting on Bobby. There he is. All righty, so great to see you all. Bobby, over to you.
Great. Thanks so much. Maybe I thought with that introduction, uh, uh, Daniel and Andy, do you guys want to just talk a little bit about sort of your practice and sort of what you do on your day-to-day basis?
Sure. I'll jump in first. Hi, everyone. My name is Andy Gelman. I'm a corporate and securities partner at Wilson Sonsini in our Palo Alto office. I really work with emerging technology companies across their life cycle, although I spend the bulk of my time working with late-stage private companies, taking them public and advising on public company and governance matters as they adjust to life as a public company. So I really look forward to talking with you all today about one of my favorite parts of my practice, which is that important transition period after a company goes public.
And hey, everyone, Dan Mochizuki, director at KPMG based in Silicon Valley in the Bay Area. Been working with both pre-IPO and recent IPO companies for the past maybe 15, 20 years or so, both the external audit side and the internal audit side, really helping companies along in that journey, specifically their kind of internal audit and SOX journey, but also their broad financial reporting journey as well as they look to become public companies. So great to be here as well. Great.
Nasdaq clearly got two great experts for this panel. And I'm Bobby Bartlett. I'm a law professor at Stanford. I co-director of the Rock Center for Corporate Governance and teach securities regulation, venture capital finance, and used to be a securities lawyer back in the day, working with venture capital backed companies and venture capital firms, often on the road to the IPO. Well, I thought I'd sort of kick off things by just asking both of you what you would say are the biggest operational and cultural shifts that founders typically underestimate when they're transitioning from private company status to being a public company. And Andy, maybe we'll start with you.
Sure. I think one of the things that I hear most frequently when I first start talking to a founder about the prospect of going public is around transparency. I think a lot of the private companies, particularly out here in the Valley, really pride themselves on the transparency and the way that they share information with their employee base prior to an IPO, whether that's all hands meetings, sharing metrics, how the company's performing, even sharing projections in some instances. A lot of founders really like to keep an open book with their employee base. And one of the conversations we get into as you start to think about approaching an IPO is suddenly your employees, which you look at them as employees historically, are potentially going to become public company stockholders. And with that is the conversation of how much information that they want to start sharing on a go-forward basis to allow their employees to trade in the shares of the company. And oftentimes there's a little bit of a path of figuring out what the right cadence of information is and reining in some of that information so the employees are able to trade. And some companies do choose to still keep a relatively open book. And with that comes obligations with respect to insider trading policy and blackout windows. I think the other cultural shift is just that earnings cycle. One of the challenges that early companies face is suddenly, you historically as a private company, you have you have your meeting with the board and you have your projections, and sometimes you obviously hope to make them, but many private companies get in the situation where they miss projections, and it's a tough conversation with the board, but it's not necessarily damning to the company. I think once you become a public company, you get in this earnings cycle cadence where you're trying to hit those targets every quarter, and the impact of missing it can be a big drop in stock price. And there's a much higher stakes and higher pressure at that point in hitting those targets, and getting used to that is always a challenge, and also making sure that that an employee base is equipped to handle that as well. Obviously you get out when you become a public company, you do your IPO. There's a lot of excitement at that particular moment in time, but that's just the beginning part of the journey, and making sure that your employees understand that there might be volatility and they shouldn't necessarily just be checking the ticker every day throughout the day is an important conversation to have and setting the right message there.
Great. Dan, how about your perspective?
Yeah, and I think somewhat related to the things that Andrew mentioned, but a big adjustment for companies is really the structure now required within the company to report. So like, you're now required to report, your 10Ks or 10Qs regularly. You're required to disclose control issues, like things like that. Like the company has to build a lot more structure in place around processes, documentation, procedures. Like how are they going to be able to achieve those things they need to report and report out those things that they need to? And that's often a big adjustment for founders, especially here in the Valley. Like companies are very used to doing everything they need to do just for the good of the operational success of the company. Very agile, very kind of fly by the seat of your pants type approach of like, we're just going to build this system here, we're going to patch this hole here, and really just run as fast as you can to deliver product and get stuff out to the public. Whereas with that IPO requirement now, you're going to look for companies, do you have the right personnel in place? Are the right people doing the right jobs? Do you have structure in place for making sure the right people are reviewing the right things? Are the right systems in place? Are those systems controlled and nice and tightly controlled? Do you have a process in place for certifications? Like all these kind of more requirements around robust documentation is a big shift for companies that are now public and subject to those requirements that companies have. And oftentimes that adjustment is quite a big adjustment for companies, which is why we often coach companies in the work that we do to kind of start that process before you go IPO, get your employees used to that structure gradually rather than kind of dropping that all on them, the day you ring the bell or the day after you ring the bell or something like that. Really, it's that extra structure, that need for control, and balancing that out with what made the company successful in the first place. But now being subject to these new requirements you have as being a public company, being able to kind of balance those two things, I think is critical as well.
Hey, Dan, on that point, thinking about sort of this kind of runway analogy where the takeoff is sort of the IPO. There's really a buildup to it in terms of this transformation that needs to happen from a financial reporting perspective. Can you kind of walk through what that looks like in the typical case in terms of as a company thinks about sort of this new cadence it's going to have to be on in terms of financial reporting, and then also integrating into that sort of novel issues for them, such as this concept of sort of internal controls, and maybe even describe sort of what Sarbanes-Oxley Act did in terms of financial reporting and what it means for founders who may not have had to go through that process.
Sure. What we coach companies in most cases is start that journey earlier rather than later. Like a lot of companies that we deal with start that journey as far as getting ready to go IPO, both from a SOX perspective, but also reporting perspective, sometimes years in advance, to just really get their company to start implementing that cultural mindset of like having controls and structure in place. That's not to say that on 3 years before IPO or 4 years before IPO, we ask companies to put everything in place, but it's a journey. And these things often take a lot longer than they expect to shift culture, to put systems in place, put processes in place. So what we'll do is we'll have companies, maybe a couple years before, put together a roadmap to say, X years before the IPO, we want to have these things in place. 2 years before, I have this in place. 1 year before, this in place. And not to say you're going to hold to that. Oftentimes you don't, but like at least the thought process is there around, we get that it's a journey. We get that it's going to be a big deal after we go IPO. Here's what we're doing as we get there to start doing those things, to make sure the right controls and structure are in place. As far as Sarbanes-Oxley goes, I'm guessing a lot of folks that call are familiar with it, but basically that's the regulation that was put in place following a lot of the financial issues that happened early in the 2000s around companies like Enron and WorldCom. It basically requires companies to have a control structure in place, and it requires on the 10K reporting that the CFO and CEO basically attest to the integrity of that control environment, along with your external auditors at a certain point after you go public as well. So like this is going to get issues in your control environment get disclosed to the public as part of your reportings. So that's why it's super critical for companies to have that structure in place to begin with. And like I said before, you can start that journey as close to IPOs as you want, but like we recommend companies start it earlier rather than later to make sure they're getting the right things in place. A lot of times these things will take a lot more time than they expect to kind of get there.
Great, thanks. Andy, circling back on the cadence question that you mentioned earlier, and sort of how that is, you have this quarterly tempo now of thinking about sort of financial reporting. There's been a lot of talk about maybe going from quarterly to semi-annual, so that you just report twice. We don't know if that's going to happen or not, but there seems to be some momentum for any of the founders sort of out there thinking about like whether or not this is how this is going to impact them. Just just a quick question in terms of do you anticipate companies still voluntarily reporting on a quarterly basis, or do you think that there could be a change in this tempo if the legal requirement goes to twice a year down from 4 times a year? Do you think that's going to be the norm, or do you think the norm is going to be continue to be quarterly reporting?
So I think my 2 cents here is if legally companies are required to do it on a semi-annual basis, like I think that'll help from a legal cost of an accounting cost of putting together the formal financial reports and the whatever it's called, 10Q, 10K, whatever they would change the name to. I think that would be beneficial to the company in terms of potentially reducing the cost of having to prepare those reports more frequently. Practically speaking, I think there will still be an expectation that companies will provide financial results on a more frequent basis and sticking with probably the quarterly model. I think the reason is, I think investors are used to seeing that and are sort of come to expect that. Perhaps, there's less information that's going to go out there on a quarterly basis if companies are only required to report semi-annually. But I would still expect that there would be some sort of level of metric, key financial, term disclosure that is done on a more frequent basis to satisfy investor need.
Yeah, thanks. And that's also consistent with what I'm hearing from investors as well. But
Yeah.
and it's probably useful for for any founders who are thinking about whether that's going to change sort of the cadence. It seems my sense as well is that sort of the cadence will still be from a functional perspective, still probably on the quarterly basis. Andy, it's similar to the question I had for Dan. Like on the legal side of sort of things, what would tend to be sort of the things that that might be surprising or novel the moment a company goes from sort of private to public?
I think it's funny because you go through this whole episode of preparing for the IPO, right? And then there's this really exciting moment. You price the deal, you start trading, and then you look up and you're now a public company, right? And suddenly you're subject to this really complex reporting regime, and you're on the hook for things, right? I think one example is AK. So now there's under SEC rules, SEC has identified a number of items that they've deemed to be material events for the company. That now, if they happen, you have to file a report and announce it to the world. And having to keep track of those things and making sure you're on top of that obligation, hits immediately as soon as you become a public company. Section 16 filings for your insiders have to report, trading of their shares. That's all out and open to the public. We mentioned 10Qs and 10Ks. That's your quarterly and annual reports that happen on a regular cadence now that, while, you probably, as a private company, you probably start preparing pretty heavy right before a board meeting, maybe 1 or 2 weeks out, to get your deck together and present the results to your board. Now you're having to do these 10Qs and 10Ks that take months and months of preparation, essentially throughout the course of the year. And the amount of work that goes into that and the time commitment, which is, given a little bit by the reference to potentially moving to a semi-annual basis, suddenly becomes a real responsibility. And along with the proxy statement, now companies will have annual meetings. A lot of private companies tend not to have annual meetings with their stockholders. And so having that on a regular basis and go through the process of preparing the proxy statement, which is a legal document that is used to inform the stockholder vote at the annual meeting, becomes part of practice. I think outside of the reports themselves, Reg FD is a really an important regulation that becomes relevant, and that relates to the disclosure, selective disclosure of material information to certain parties. And so having to keep close tabs on who's able to speak on behalf of the company and who they're able to speak to is really important as a public company, because your shares are publicly traded and can create regulatory issues if you don't do so. And I think more broadly speaking too is, generally as a private company, litigation exposure generally, not always, but generally from stockholder claims is much less. As a public company, as soon as, we talked about that earnings cadence, as soon as that price drops, immediately you end up with those potential, litigants coming in and trying to bring claims against the company.
Switching a bit to sort of thinking about the types of company that go through an IPO, they typically are doing this at a juncture where there's a lot of growth and momentum behind them. I guess I'm curious to hear your perspectives, both your perspectives on as a company is sort of thinking about the IPO process. What sort of separates those that continue to maintain that momentum and growth following the IPO? You sort of have observations on when companies are able to sort of sustain it and when they sort of tend to stall out after their IPOs. Dan, maybe we'll start with you.
Yeah, and I think speaking more from a financial controls perspective as well, I think what we see for companies that can sustain that growth is really the scalability of their processes. Like, do they have the right systems and the right process in place that can sustain increases in revenue, increases in personnel, increases in customer base? Or have they kind of been, like I said before, kind of patching holes or kind of running, as best they can to get there, in whatever ways they can. So really taking a step back and looking at what systems do we have in place, what people do we have in place, how is the company structured, and is that structured in such a way that if revenue doubles or we get a ton more customers tomorrow, that we will be able to sustain that, or are we reliant on one person doing a ton of tasks, or we're reliant on homegrown systems that may not work very well. Do we not have the right kind of controls in place to control these things? Like really looking at your processes in your company and saying, how are we structured? Do we understand how these end-to-end processes work? Like, do we understand how our whole revenue process works? Do we understand how our procurement process works? Is that documented out? And are we positioned to say, okay, like, can this sustain a big intake of new information or new data? And are we built that way? And looking at that, and like I talked before as well, like recommend starting that process earlier rather than later. Because a lot of times when companies go public or they do these process reviews, like this is the first time they've ever looked at their end-to-end processes before in totality. Like a lot of times it's like one person does, the order process, one person does the invoicing, one person does the AR, and those folks often don't know what the groups before them are doing, and they're not interacting with them. So like kind of looking at those end-to-end processing, where is there maybe, key breakpoints in that process? Like we're really relying on this one single person to approve all the orders. Like that's a problem. And where is there potentially duplication by the same token? Like, oh, like this step's happening down here, but it also happens up here. And looking at that and saying, okay, like really streamlining that process, saying like, okay, like this step's really manual. Maybe we need to think about a system here, like a Coupa or something like that, to make this process better. Like looking at the end processing, where can we make this better, and is this sustainable? Is probably a big factor we see, at least from financial reporting perspective, on the growth side of it.
And I'm not familiar with that term. Coupa?
Oh, sorry. Coupa is a procurement system. I was using an example of like, if you're doing invoicing manually or vendor management manually, like you could put a system in place that'll help you do that, like that kind of thing.
Got it. Okay, thanks. Andy, how about your perspective?
A lot of this I feel like is less on the legal side and more on the business side. But I think, from the outside looking in, I think, my perspective is, company one is it's a company is at the right level of maturity when they go public. I think having the right team in place and having, looking out in terms of the long-term model and having a vision of what the company is going to be, not just at the time of the IPO, but the years that follow the IPO. I think are the ones that really are successful and are able to sustain growth as time moves on.
Andy, in terms of sort of corporate finance and capital raising, most companies that I suspect sort of considering the IPO process are most likely a customer raising capital privately through sort of venture capital, other private investors. They probably have a fair amount of freedom of action when they want to engage in strategic M&A, for instance, or other types of strategic transactions. Can you talk for a bit about sort of the considerations that sort of they'll have to now undertake once they're a public company in terms of both raising capital as well as engaging in strategic transactions?
Yeah, for sure. So, I think, when most of our venture-backed companies go public, usually the capital raise, most of the time we see capital raising in the form of convertible note offerings within several years after they go public. That's most typical for technology companies. I think one of the biggest values of going public, frankly, is the ability to use stock as a currency for M&A acquisitions. And I think in the year or two following an IPO, you see a lot of these newly public companies really leaning in towards M&A and taking advantage of that opportunity on a go-forward basis. I generally see less capital transactions in terms of, secondaries for VC-backed companies. Usually those type of follow-on offerings are more typical for PE-backed companies, but not totally unheard of. And probably see, less in terms of primary equity raise as a form of raising capital after the IPO. Like I said, a lot of these convertible notes, which are usually fairly low interest rates, and generally, pretty nice terms for companies in the several years following IPO.
Is that a more of a novel sort of structure over the last sort of decade or so, or is it?
Yeah, I'd say maybe like the last 20 years-ish or so, but it's big in, I mean, if you look at the bucket of private companies, I mean, you really see that as a common, common way for technology, high growth technology companies to raise capital shortly after IPO. It sort of goes from like convertible note to high yield debt to investment grade debt is sort of the transitional period of how companies generally look at capital raise after the IPO.
Okay, interesting. Given there's sort of a history of a lot of early growth companies sort of not using conventional debt, but the fact that you're using convertible debt in this context is of note. Dan, I want to circle back to this concept of SOX compliance, which I do think is one of the more intimidating aspects of the financial reporting regime that changes. Can you talk a little bit more about what that compliance looks like, what it means in terms of signing off on internal controls? I mean, I think some people may even be wondering what are exactly internal controls and how can
Yeah.
a CEO or CFO be in a position to sign off on them?
Sure. So yeah, at an overall level, so the SOX law has kind of a couple key components to it. One being kind of the what's called the 302 and 906 certifications, which if you kind of go to the back of a 10K or a 10Q, you'll kind of see those sign-offs in the back there. But those are basically the CEO and the CFO attesting to the fact that we stand behind what's disclosed in this report from a financial reporting perspective. It complies with SEC rules, and it basically holds them personally accountable for what's in that document. So basically, like they can be liable if there's inaccurate financial reporting or anything in there. So that starting when a company first goes IPO, starting with the first 10Q, the CEO and CFO have to basically put those attestations in the back there and sign off. The internal controls component of SOX, which is the area that most people talk about, I think more, and is probably a bigger burden for the company, doesn't come into play until the first 10K after the initial IPO. So for example, if you go IPO, say, today, November 21st, 2025, your first 10K is as a 12/31/25, your first 404 compliance report isn't until the next year. So 12/31/26. So companies effectively get 1 year from their IPO date to basically get compliant with 404. In terms of how companies get there, that's where kind of that structure in place we talked about comes into play, where, of course, the CEO or the CFO is not going to know every little thing that happens in the company and every single control within the company. They're going to be very reliant on having a structure and a process in place such that they can be comfortable making those assertions and making things there. So when we talk about what is a control is basically at its most basic form an activity to mitigate a risk. So basically, when companies go through their SOX setup journey, you have to kind of look at your financial statements whole and say, okay, what risks do I have in here that could potentially impact what's disclosed in these financial statements? Like, for example, if we're talking about revenue, what are all the steps in the revenue process where something could go wrong that would cause a misstatement in revenue? Like, is revenue being recognized appropriately? Are orders being captured and recorded appropriately? Are they being approved? Like things like that. So those are all areas where we look for what we call controls. So like, for example, like in revenue recognition, is someone reviewing that to make sure it's accurate? And is that person the right person to be doing that? If we're talking about order entry, is someone reviewing order entry to make sure that's happening the way it's supposed to happen? Like a lot of times it talks about this concept of review, or in some cases, if you're using a system, relying on the system to do it, make sure that like what you're getting to is accurate. And the end goal is basically like, are those numbers you see on the financials accurate numbers that you can stand behind? And that happens through this concept of internal controls and making sure that I have the right systems, processes, and people in place that I feel comfortable that I'm going to get to the right outcome there. And I'm doing testing throughout the year on those controls to make sure, okay, like if this control didn't work here, what's the impact of that? And like sometimes companies will do that with an internal audit department. Sometimes they'll hire an external party to do it for them. But having that monitoring in place, say, okay, I feel comfortable I can identify where these issues are. And if an issue does come up, I can do an assessment to say, okay, what's the impact? Did it affect reporting? And what do we need to do to fix it going forward? And kind of putting that process in place before you go public is ideal. Getting companies used to that, because companies that go, okay, I just went IPO, now I'm going to start SOX, are in for a really rough ride probably in the first couple of years of compliance there. Whereas the companies that start out earlier tend to go a lot better. And it's, like we said before, it's a journey, and it's a big shift culturally as far as what companies are expected to do. So just changing that mindset of companies too, it's good to start that earlier rather than later.
And I assume that comes with
getting handle on the controls. Yeah.
Yeah, and I was just gonna say, I assume this comes with new personnel that you're gonna have to have with this resident expertise.
It can, yeah, depending on what your company looks like today. And like I said, some companies opt to hire external parties, help them with compliance, or even kind of with their internal accounting departments as well. But kind of moving more towards that's a big shift as well, which I think we alluded to earlier, is kind of, when you go public, there's a lot more things you have to do and a lot more expectation around how responsibilities are allocated. Things like segregation of duties, making sure that you're not putting people in positions where they have conflicting duties, and making sure that you have the right qualified people in the right roles. We see companies do a big upswing in hiring, not just from a SOX controls perspective specifically, but even in their accounting groups, in their other groups operationally, just to make sure they have the right qualified people in the right roles, and those people aren't being asked to do things that they can conflict with. They can't approve their own work, like things like that. So that's a big shift too, is that upswing in personnel and employees.
I'm curious, maybe if you can share some war stories, and just this question actually for both of you, but maybe Dan first on war stories on sort of where you've seen sort of a fumble or worse on these control failures after IPO, maybe as a cautionary tale for all to avoid. And Andy, I guess on the compliance front too, and in terms of what you've seen that founders might want to wish to avoid themselves.
Yeah, I mean, we're increasingly, as some of the folks on the call might be aware, like we're increasingly seeing auditors give companies what we call material weaknesses, even pre-IPO, as part of their S1 filing. A material weakness is basically saying like that you have a significant issue in your control environment that's could potentially lead to a misstatement. Not that it did lead to a misstatement, but that it could, given like what the control environment looks like. And a lot of times, because auditors are giving companies those weaknesses very early on, they're kind of very broad. Like it's basically saying you don't have the right personnel in place, your IT system is broken, like things like that. It's like the biggest fumble I see companies do is starting too late. Like not, because a lot of these issues take a long time to fix. Like if you have to fix a system or hire a bunch of new people, or fix a very broken process, that can take sometimes years to fix. So starting really early on, I think is the biggest thing we see companies not kind of get it right, is assuming they're just going to handle that after they go IPO, and then it creates this insane rush in their first or second year of IPO to kind of get compliant and try to fix these issues. The other big fumble is trying to almost like band-aid solution issues, like, oh, I'm going to fix this issue today, but not necessarily look at the root problem. Like maybe the root problem is this system we have running our order management isn't actually a good system because we just built that in-house and didn't really think through how we would sustain that system going forward. Like looking underneath to say, okay, like not just look at the top issue, but what is the root cause of these issues we're having? And the biggest areas we see there, like I said, are IT-related systems, personnel, and just having kind of the right level of documentation on your processes in place. But looking beneath the hood to say what's going to sustain us going forward, not what's going to solve the problem today. Because a lot of times companies will try to get around, okay, well, we don't have an issue in our controls. We'll slap this remediation on it. We're fine this year. But it's not a sustainable fix. And like in going forward in the years, that it creates an issue going forward. So in that first kind of year or two after IPO or before IPO, really take a hard look at where are the issues and be really honest with yourself as a company as like, okay, like, this system we have here is not going to work long term, and we know that, rather than try to kind of ignore that problem and say, well, we'll fix it later, kick the can down the road. Like take opportunity to say, in these years before the auditors are going to audit our financials, or our controls before we go IPO, like where are the problems? Be real honest about what the problems are and like what that fix is going to look like going forward. And maybe it's not something you fix today, but at least like you're aware of where those issues are, and you have a roadmap and it's on the radar and a thought process in place to look at it at some point in the future.
Andy, before we get to you on the compliance side, Dan, just to double click on what you said there. For a founder that sort of they just had a clean audit, for this sort of situation where now, the risk, the risk of a material weakness, like, can you just say a few words in terms of like what a founder, so that founders can get a sense for like if that's going to be a risk for them, even if they just got a clean audit, now maybe that there's going to be some sort of new analyses that are undertaken, because of the regime that the public company world imposes on them. Just so the founders can get a sense for like, okay, when do I start to really need to talk to my auditor to prepare for this?
Sure, sure. And yeah, an important distinction there, which you alluded to, is you can have a clean audit, which means like your financial statements are accurately presented and still have a material weakness. And material weakness basically means that your control environment is such that like a big issue could happen. It may not have happened, but it could happen. And like that's what auditors are going to look out for is like are the right structure is the right structure in place to prevent a big issue from happening. And maybe it didn't happen because it hasn't happened yet or someone hasn't done anything wrong, but the opportunity is there. And as far as preparing for that, it's like you don't really know where your material weaknesses could be until you've looked at your processes end to end. And like, so this is where it comes into play of like, we recommend, not just starting to think about SOX early, but start to talk to your auditors about SOX early on too. A lot of times we see companies start talking to auditors about deficiencies, about issues, about material weaknesses, again, years before going IPO, and they start engaging with them saying, hey, can you take a look at my process? Or here's my process flow, external auditor, can you take a look and just see what you think? And like, they often appreciate that as well because it helps to prepare them for when they will have to audit those after you go IPO. Like they're very appreciative and often very helpful when you bring stuff to them early like that. Like a lot of times people think of auditors as like, oh, I want to talk to the auditor as little as possible, or I'll just give them exactly what they need so they go away, like that kind of thing. But the more successful companies we see really view auditors almost as like their partners to say like, here's what we have going on pre-IPO, like here's our process, like, we've identified issues here, and here that we're going to fix. Here's our path forward. Like, what do you think? Like, they're more than happy to provide that perspective too. And giving them that transparency also gives them a little more firepower to say, okay, like maybe we would have called this a material weakness before, but like we see what you've got in place here now. We're not going to do that now. Or like, working with an external advisory partner as well, or consulting partner to help you with some of those conversations if you don't have the right people at your company to say, to be able to kind of go toe to toe with your auditor to say, okay, challenge them a bit, to say, you're calling this a control issue. We don't think it is because of these reasons. Like having that right kind of backing to have those conversations. And again, it comes back to starting early. Like if you have those conversations with your auditor a year or two before going IPO, it makes it a lot easier rather than when you're trying to scramble to file an S1 or scramble to list, all trying to get your auditors to sign off on something like that as well. So, I mean, things like material weaknesses and control issues, they're definitely out there and they're definitely things that happen. But I think like any other thing, kind of with the right preparation and the right conversations ahead of time, you can help to mitigate that quite a bit.
Great, thanks. Andy, how about you? What do you when you see companies that sort of have compliance crises right after the IPO process or in their early years of being a public company, what do they typically revolve around?
I'll just piggyback on what Dan was talking about real quickly on material weakness. I mean, I think obviously, the issues we see most frequently around that is just not having the right personnel. But I will also say that they do come up in the context of an IPO. We've taken many companies public that had material weaknesses. So while I certainly, we try to avoid it where obviously it's great to, ideally to avoid it. It doesn't necessarily, it won't prevent you from going public.
Good point. Yeah.
And it just becomes a process to get through that. I mean, I think in terms of, what I see where things, where folks drop the ball. I mean, I think there's an enormous amount of rigor through the course of the IPO that goes into supporting, backing up, making sure every statement in that S1 document is accurate. Whether it's the financial information, obviously there's the audit that gets done, but also like the factual statements, operating metrics, key metrics, things like that require a ton of diligence and rigor through that process. And I think where I see some companies, get into a little trouble post-IPO is not maintaining that same level of rigor for each of those, 10K filings, 10Q filings. And the last thing you want to do, I mean, there's always the risk of a restatement with respect to the financials, but there's also sometimes a need to amend a 10K because of a misstated metric or something like that. It's not a restatement, but it's certainly not something that a company wants to do. And we've talked, previously about losing credibility, and that's a way to lose credibility early on is by having just metrics that are wrong in your document. I would say the other area is, I mentioned earlier 8K obligations, and having the right team to sort of be on track with that as well. Ideally, you don't want to miss, an 8K obligation early on. That can have ramifications for capital raising. There's a certain type of registration statement that you can only file if you haven't. Once you have to be a public company long enough, but you also can't have missed a certain subset of 8K obligations. So it is important to hit those, and it's difficult to sort of keep track on that immediately as a public company and realize you may have an affirmative obligation to disclose to your investors. I think a new requirement is around disclosing cybersecurity events, and I think has most newly public companies on edge in terms of the overall set of 8K obligations there.
Yeah, and on that, 2 points you mentioned that might be useful to flesh out for folks. So one on that, making sure that all the statements are correct within your S1, but also going forward in your 10Ks. But on the S1 especially, obviously there's potential liability, and there's real risk for liability if the stock underperforms after the IPO. There's always a risk that then someone's going to come back and say there was something that was some risk, that was hypothesized in the prospectus was actually sort of material at the time. That's a very common strategy for a lot of litigants currently. And so in terms of just risk mitigation, what are some of the best practices that you recommend to executives and directors because there are these, there's the due diligence defense, of course. Like, what are some of the best practices that as a company is going through this IPO process, drafting prospectuses and registration statements, like what can they do if in the unfortunate event the stock underperforms and they find themselves the defendant in a Section 11 case? In terms of what do you recommend during the IPO process to help mitigate that risk?
So, I mean, I think, having a strong team around you to navigate through that process is incredibly important. Throughout the course of the IPO, part of the job of the legal teams involved is to literally back up every single factual statement that is said within the S1 document. And I think it's important, while the lawyers are kind of behind the scenes working on this, we're really a partner with the company and pulling that together and developing that culture of saying, hey, if we're going to make these statements, we need to be able to support them and building that support behind them. The end of the day, if your stock price drops, no matter what you've done in the background, like, you're probably going to end up with a lawsuit. But what you can do is to make sure that when that does come, you have all the support, you've sort of taken the steps to be able to have the defense that you've done the diligence necessary to support those statements. I think the other thing that's sort of part of the S1 drafting is like you do everything you can do to support it, but what else can you do in terms of disclosure to give yourself a defense if you end up getting that claim? And I think the other thing is risk factors, something that lawyers love to talk about in connection with IPOs. Is you end up with like a 40-page document, 40 pages of nothing but everything that could go bad with the company. And a lot of times we have this conversation with the founders, CEOs of the companies, like, this makes us look really bad. Why would we want to say all this stuff? The reason is because if you do get that claim in the future, so something bad happens, stock price drops, someone brings a claim. If you're able to point to a specific risk factor, say, hey, I've said that this could happen to us, and it is happening. So you knew about this going in, and it just came to fruition. You have a pretty good defense there in connection with litigation claims. So I think being supportive and collaborative and trying to figure out what those potential risks are can also really help post IPO if a claim comes. And it has happened. I've had clients that stock price dropped, they got the lawsuit, and immediately thrown out on motion to dismiss because we were able to point specifically to a statement in the risk factors that identified that exact eventuality happened.
Great, thanks. Before we open up to questions, I definitely wanted to get both of your perspectives on a topic that has already come up, which is personnel, and how firms, founders should be thinking about both their board level governance in terms of who should be a director, what the board of directors should look like as a public company, but also just personnel more generally too. I mean, what should a CFO, what skill set should a CFO have in order to enable success as a public company, given all of the demands that they'll have to face. So Dan, do you want to say maybe a few words on how founders should be thinking about their finance department and the personnel who should be there and at the helm?
Yeah, I mean, and I could speak probably more to the financing kind of group as opposed to the board aspect of it. But I think, as far as how they think about that, I think, we do see situations where a lot of times companies want to keep founders kind of in those key executive roles, even if those founders may not have the background necessarily to run those roles, like for example, a CFO role. I think the key thing is not necessarily that individual person has that particular skill set, but do they have the right people below them? Like really look for, if the founder wants to be the CFO or something like that, like make sure they have the right people below them that can support them in that. Like make sure you have a really experienced CAO or VP of finance below you that can support you there, or like look out for those folks. And a lot of times that's a journey too. So you're not going to go and hire all those people in year one or previously, but really look for people that have been on that public company journey before. Because the difference between a controller or a CIO that's been in a public company or taken a company public versus one that's been only at private companies or only been at a company that was already public is massive, because they know what that journey looks like. So obviously kind of having the skill set is there, but like having that experience of having gone public before, having folks in key finance roles with that experience, we found is super helpful as well, because they know what it takes, they know what it entails, and looking for that level of experience too. So obviously technical skill is important, but having been on that journey before too is also a huge factor also.
Andy, what do you think about on the governance side when you're advising companies?
Yeah. So I mean, I think board composition and board structure is probably one of the things that has the other than maybe the accounting side of the house, is probably one of the things that takes the longest lead time to settle pre-IPO. So pre-IPO, generally your boards can be pretty nimble. It might just be the founder, maybe a couple of, a few VC, designated board members that are sitting on the board, and really operates like a strategic advisor in a really high growth environment. Post-IPO, public companies are subject to certain Exchange Act rules that set a lot of structure around the IPO. There's requirements to have specific committees, audit committee, comp committee, non-gov committee. There's independence requirements for the board members. I think that, in terms of the board, the audit committee is probably the committee that's the most time intensive, but also the hardest to fill. And oftentimes I see that audit committee chair as being really the key piece that needs to be filled pre-IPO. And while I say it takes a while to fill the board, I think it's also important to set the board early enough where they can get a little bit cohesive before you actually go public. I mean, I've seen it before where the boards literally fill, they sort of set up the board, a few weeks before the company flips public, and you're sort of right there becoming a public company with a new board that doesn't really have a rapport with each other. So I mean, I think in terms of other skills that's important, I think, like I said, audit committee, having that financial expert there is a hard one to fill. It's important to look out for. I think folks with compensation and governance experience, particularly with public companies, I think that's, a way where, like I said, you're kind of going from strategic advisor to being more in this like structural oversight role as a public company board member. And I think having folks with that level of experience it can be really valuable addition to the board.
Great. And I'm not sure, I don't think I see any questions in the Q&A, but I can continue to ask some of my own. I guess do you both too, I think on it's sort of kind of on the personnel front thing in this domain. Investor relations is going to be a new responsibility for a company that goes public. I'd be curious to hear sort of both your thoughts in terms of how a company should think about managing that process. What does shareholder engagement look like? Andy, do you want to maybe say a few words in terms of how you all advise companies?
Yeah, and I mean, I think investor relations is one of those roles that generally private companies don't really have until they get closer to the IPO, and usually I see companies probably maybe a year or so out start to look to fill that position. I think it is important to have that in place as you enter the IPO process. I find the IR team is very helpful as you go through the drafting of the S1, sort of figuring out what those metrics are going to be that you want to disclose on a quarterly, annual cadence, but also but also, hoping to craft that narrative that ultimately is going to be communicated to investors. And they can play a really important role in, through the TTW, testing the water meeting process with investors as you go through that. And then obviously once a company does, go public, going through the earnings cycle and engagement with investors throughout the course of the year. It's a primary function of the IR, and so I think it's really helpful to have that lined up there. I think I generally view, like I said, the IR is like sort of an integral part of that IPO core team, and so I think it's great to get them set up early and ready to go, so that when you kick it off, you hit the ground running.
Dan, you have any thoughts on the companies sort of in terms of their public-facing investor engagement, shareholder engagement?
I mean, I'd probably echo kind of what Andy said as well. I think just starting early and getting those folks in place around investor relationship early on is really critical. And like we talked before with other processes, like really thinking about before IPO what you want that process to look like, and like kind of start working towards that. And maybe even as long as a year or two before IPO as well.
Colin, did you? I think you mentioned there's a question here.
Awesome. Yeah. Well, first of all, Bobby, Andy, Dan, what a great overview. I know there's a lot of detail there, but you covered a lot, and you did a great job. We have some pre-submitted questions as well that we can cover during this. So I'm going to toss them out there. Feel free to sink your teeth into any. And Bobby, you're also on the hook for any of these that you may have some guidance on as well. Sound good, team?
Sounds good.
Yep.
All righty. Well, so we've been covering a ton on the IPO process today. And so everything from preparing for it to the listing to now what we're talking about now in terms of life as a public company. What's one thing that you think a founder should be preparing for or doing now to ensure success in listing in the next 12 to 18 months? Andy, you came
I'll
up.
piggyback on what I was just talking about. I think figuring out your board, figuring out if you have the right people sitting around the table. If you need someone, particularly like I said, the audit committee chair, like that is a hard that can be a difficult individual to find. And I think starting that now and getting your board baked ahead of time will create a better rapport and a better dynamic as you approach the IPO, but also post IPO as well.
Awesome. Dan?
Yeah, I think again, kind of going back to what I said before, just really taking a hard look at your company and your process and your financial controls early on, and kind of thinking, not where is every issue, but where are the real big issues that we have, or where do we think there's big gaps we need to fill, and start thinking about how do we fill those gaps, and not to say that every gap needs to be filled before you go ring the bell, but just again have a plan in place for like we've done a review, we know where our potential issues are. And we've got a plan in place to fix those at some stage in the future.
Awesome. And Bobby, you're my resident governance expert. Any advice there?
No, I think I agree with everything they said, and I think that just reiterating something that both Dan and Andy have said is that I think the more that you can sort of do a dress rehearsal for being a public company, which requires a lot of planning, because you really need to have that dress rehearsal happening sort of with a year of financials or maybe 2 years of financials. So it's a long-term project, but you don't want to start running a marathon without preparing for it. In the same way is true of being a public company. You want to have some muscle memory already developed, have some conditioning already down.
Yeah, that's great advice. Okay, Dan, I think you might be able to take this one, but feel free to pass. So once public, how should companies start thinking about their data privacy around their financials, cybersecurity, incident disclosure obligations, anything there?
Yeah, so I think there are some requirements around cyber and kind of data privacy that are going to be required for public companies, and kind of your auditors, your provider, kind of help to speak to a little bit what those requirements are. But it comes back to like looking at your IT environment as a whole, and like things around like IT security, access, who can make change to the IT environment. All that stuff is expected to be covered kind of as part of your IT control environment as part of your public company compliance. So like as you work through some of those steps, some of that stuff you'll come across it and kind of look to remediate it, as it comes up in the course of that work anyway. But that's something that kind of like a hiring an internal SOX person or internal controls IT person can help you a lot with, is getting a handle on what are the requirements and what do you need to do right now versus what's nice to have, what's required, like drawing those distinctions, having conversation with auditors, and all those things. But there will be key parts of data privacy, of cyber, of security that will get covered as part of your SOC compliance, just inherently also.
Great stuff. Andy, the last panel talked a little bit about how preparing your employees, your executives for this process internally is important, but how do compensation structures like equity refreshers, bonus plans, performance incentives shift after the IPO?
Yeah, so companies typically refresh equity plans in connection with the IPO, and I think generally what we've been seeing is a lot of tech companies have already made the shift to RSUs by the time that they are approaching an IPO. But if they haven't, usually that's a pretty fundamental shift that you see companies start as a primary form of equity award being restricted stock units as opposed to stock options. Typically that they begin to vest on quarterly cadences, and shares are often sold to cover tax withholding. So pre-IPO, if companies were previously granted restricted stock units, basically they're most often set up as what's called double trigger RSUs. So there's a time-based condition that's subject to service, but then there's a condition that it basically results in vesting upon the IPO itself. And so at the time the IPO hits, there's usually a big slug of these RSUs that suddenly become, suddenly settle. And employees for the first time are able to really sell and get liquidity in the company. So I think in addition to managing the go forward, it's also managing that influx of, potential wealth that goes to your employee base and, continuing to find ways to incentivize them on a go forward basis.
Awesome. Thanks, Andy. Bobby, what role should the board and advisors play during more moments of instability or also known as crisis readiness?
Yeah, well, as fiduciaries, the board, they have to be aware of these corporate crises, and the company should have protocols in place. So again, it goes towards this idea of you don't want to sort of have the first time that you're looking for people's sort of cell phones. After the crisis happens, you want to make sure that you've got a crisis plan, you've got communications, and you've got basically sort of attack on the company and its email systems. Like you need to have alternative ways to communicate with your board and advisors. So I would say just being crisis ready is, I think, part of this preparation that needs to be happening in the lead up to the IPO.
Rolling right along. These are great questions, Dan, I got one that I think you covered, but somebody submitted one early, so I wanted to double click on it. What are some of the most common consequences of failing to establish strong internal controls earlier on?
Yeah, interesting question. So there's kind of the formal consequences, and there's also kind of the, like, I guess, less formal consequences. So I think, when we think about just the impact on the company, if you don't look to establish those controls early on, you're going to be put in a position where those first couple of years of IPO are going to be really hectic trying to get that stuff in place and being able to comply with the auditor requirements when they come in and start to look at that, complying with the reporting cadences you're going to be held to, and everything that comes with that. So it creates a lot of additional stress in the company, just like to have to do all these compliance exercises that probably could have been started a little bit earlier. So kind of starting too late leads to that consequence. I mean, obviously, if you do start too late and can't get everything in place, at least we talked about before, like these material weakness discussions, like these things get disclosed in your financials, can affect investor confidence, can affect share price, affect a lot of things there. So like it can impact you, I guess, both from a formal reporting perspective, but also just, the health and culture of your company in general. It can just create this undue stress amongst the company of like, oh, we've got this tight timeline to do these things now, and now we need to do them. So there's kind of the formal consequences, but also the, I guess, informal consequences that come with that as well.
Yeah.
I'll just add to, like, while I said it won't prevent you from doing an IPO. If you do have a material weakness as you're leading up to it, you will get put through the ringer. There'll be diligence calls, there'll be risk factor disclosure. So it's not necessarily fun to have one, even though it won't necessarily, you know, restrict you in order and from actually getting the IPO done.
Yeah, absolutely. Like companies with material weaknesses, like the audit committee will ask about that every single time they meet. Like, what's going on with the material weakness and how are you fixing it? Or the, you know, the key financial people, CFO, CEO. There's gonna be a lot of pressure on the company to remediate those,
Yeah.
and get them remediated as soon as possible. And if that doesn't happen quickly, you know, that often has consequences for those individuals in key roles, I guess, as well.
Awesome. Andy, Bobby, I think this one could go to either one of you, but what should founders consider when hiring executives or recruiting board members who have public company experience?
I think Andy's probably better positioned to give a lay of the land on this.
Yeah, so I mean, I think it depends what role that we're talking about. I mean, I think one of the critical roles pre-IPO is the CFO. I think having a CFO in place that has some experience, very important. Same to some degree with your chief accounting officer. I think between those folks, it could be the same person, but I think between those folks, that is a position that is really important to have filled and have some experience with the company before you get deep into the IPO process. I think I mentioned it with board members. I mean, audit committee, financial expert, that's sort of a key one. You know, having broader, like, you know, not governance, compensation committee experience. You know, a lot of time is spent on comp post IPO, and having, you know, folks on that board or on that committee that have some experience there can be really helpful. And I think generally, you know, just from a governance perspective, to the extent that you'll be required independent board members, but independent board members that really bring something to the table is I think can be really important. I know there's always sort of a tendency to bring in the celebrity board member, but I think, you know, to the extent that you can, you know, bring people that add some sort of element that is important to the board, I think it can be very helpful.
I'll just chime in real quickly too. I mean, I think that the good news for founders is that, you know, there's just a lot of really great consultants and services firms that can really help identify talent in this regard. So there's the founders don't have to sort of find these people on their own. There's definitely sort of turnkey services to help them find the right fit for their company.
Amazing. And my first step would be outreaching smart folks like you three, Dan, Andy, and Bobby, for advice. Well, what a great conversation, and what a great end to our IPO Bootcamp today. Dan, Andy, Bobby, thank you so much for the time, for sharing your real world insights, and for helping close the loop on this IPO Bootcamp. Thank you both. Thank you all so much.
Thank you.
Thanks, Joe.
All righty, for our attendees, thanks for hanging on with us for this IPO Bootcamp. We really appreciate you joining us and hope all of the information shared was valuable. We'd love for you to join some of our upcoming webinars so you can view them in the events by using the link in the chat and in our follow-up. Thank you all so much for joining us today. We look forward to welcoming you all back online soon. Dan, Andy, Bobby, thank you so much.
Thank you.
Thanks, Joe.